Welcome back. This is the third part of our intraday workshop. So let's just quickly refresh our memory what we talked about. So we talked about the importance of the higher time frame for the intraday trading, going to, let's say, to the daily, understanding the daily swing bars, understanding the daily structure, going maybe even slightly higher to the weekly, monthly, just to understand the whole history of an instrument, or maybe there is a much larger structure. Then we've talked about specifically with stocks, how the selection of the popular momentum stocks, is really good because we want to participate in our in the stocks that are going to be extremely volatile. And usually those popular momentum stocks, depending on where they are in the structure, are going to provide us with that opportunity. Then we talked about general guidelines and rules for day trading stocks. And there are quite a few of them, so I'm not going to go into that. We went through the comparative analysis of the first 30 to 60 minutes, and it's kind of crucial to see what is outperforming during a specific day, on a specific day, and that could be your selection criteria. We've talked about the importance of keeping it a little bit simple, not having a lot of stocks to look at for the day trading, because it's just going to distract you and it's just going to be too much to handle. So now let's talk about the idea of a switch from the intraday entry to a swing trade. So specifically here, I'm looking at Google again. It's one of the momentum popular stocks that people would be inclined to day trade, to swing trade. So we want to participate in this stock. We're looking at the long-term structure, and by long-term structure, I'm seeing here almost a yearly range. Really quickly, labeling, we have a change of character here, so therefore this is a climactic action, automatic reaction, secondary test, phase A. And then if you look at the whole structure, and the question was, I was asked a question, why is this not a C? So one of the things here is that we have to think in terms of the areas of the tests, right? So what are we testing here? Where are our tests? So here is the first area, here is the second area, and here is the third area. So if I would label them with the phases, this is going to be the labeling. So therefore, my C is here rather than here. Also, another point is you think about where is a sign of strength here. So, and clearly this is a sign of strength, and this is a backing up action. And please note how nicely on this slope here we have the touch of this support. Just works out extremely nicely, and this is the second low right here. So where is the sign of strength? Right here. So the previous low before the sign of strength is going to be the low for phase C. So therefore, this is how we would look at the labeling of the structure. The trade that we're going to consider is going to be here, all of this. So we're going to be looking to intraday trade this area right here. And obviously we're doing this on purpose. We're doing this on purpose because if we understand the long-term structure, we can start thinking about how we can day trade, a possible move to the upside like a sign of strength. So let's look into this area right here, and let's see what kind of structure we have here. And here is our structure. So again, a couple of questions here, very interesting spots to consider for labeling. So obviously a long-term phase C, and then within this long-term we have another trading range, which we could label as well. All right, so why do I put automatic reaction right here, and the climactic action could be either here or here? Well, I'm looking at the change of character. Change of character relative to what? Relative to this move to the upside. This was the move. This was the swing up. I'm looking at all of the reactions here, and I'm seeing that this reaction right here is the largest reaction. Plus, it also broke the trend. So therefore, that would be a change of character reaction. If this is a change of character, so therefore, this is going to be an automatic reaction right here, secondary test, as a test of the previous highs, secondary test at the bottom, for the support, a test of the previous lows, another test. Second point of fear, we could see it very clearly here. Spread is increasing. Supply is slightly increasing relative to B. So that's definitely an indication of phase C, and then a sign of strength. Again, for the smaller trading range, this is probably a backing up action that we see here. So what we want to do next, now we are at the daily, now that we are at this phase C, we're looking at phase C again, and we want to look, there is another trading range right here. So we can't really see it on the daily, so we'll go to the intraday. We want to understand the intraday price structure. We want to understand the daily swing reversal, and then we'll talk about the predominant intraday trend, which will help us to understand what kind of how we're going to use the stop loss. Still, the trade under consideration is all of this. So here we're looking at the daily swing reversal first in this smaller trading range, and then we're looking at the last commitment to the downside, which was you could consider this too, maybe even this, an attempt to commit to the downside. And we see that either was this bar right here or definitely was this bar, the downswing has been reversed, and now the bias is to the upside. And we kind of like logically going through all of the steps. We looked at the long-term picture, we looked at the shorter-term picture, now we're looking at even shorter-term picture right here. Now we're going to look at the intraday action of this area right here. So this is the range, and let's just quickly label this. Change of character is the largest rally on anything that we've seen before for this move to the downside. Secondary test, phase A, test, another test, possible spring, minor sign of strength. Why minor? Because there was a higher low after that, but yet the price came back to the trading range, but it acted as a sign of strength. So we'll label it LPSY test of the spring. Next one, LPSY test of the spring. Final commitment above, sign of strength, and a backing up action, which does not even come back to the support, and that shows, a strong structural strength. Okay, so what can we do here? We definitely see that the reversal of this swing has happened and has been confirmed on this day. So our bias is going to be up from that point of view, daily swing bias. Our long-term structural bias is also up based on the fact that we are in phase C of a larger phase C. So our long-term structural bias is up as well. Now let's look at more of the intraday action, and let's see where we could potentially have a point of entry. So as we are expecting a sign of strength on the intraday basis, as we see the gap, we are probably thinking that this gap is our first commitment to the upside. If we're gonna day trade this day and we're gonna end up with the price not coming back into the trading range, this is going to be a true sign of strength indication. So therefore, we are starting to trade on the intraday basis with an idea that potentially by the end of the day, we might switch and have a swing trade after that. So we go to a lower time frame, 5 minutes. And by the way, you can incorporate the comparative analysis with other stocks, as well. But your, structure is going to dictate that you're probably going to day trade this stock around this area one way or another, and then just hope that one day is going to be a trending day, and you can leave the position on. So let's look, oh, I see, okay, what I wanted to show here, okay. So I'm sorry, I'm just going back a little bit. So I wanted to look at this rally right here, because this rally acts as a change of character on the way out. Look at this, right? The biggest rally that we've had so far in the range. So we definitely want to figure out, could we have a point of entry after the reaction here? So let's look at the reaction. So here is this rally, this minus sign of strength. We're thinking potential change of character. How do I write it like this? Potential change of character. But then we are waiting for the reaction, which we expect is going to be the smallest reaction, in the trading range, and then we have this type of the reaction. What do we see here? We see that the spread is increasing, and we see that the volume is increasing, particularly supply is increasing as well. Our rule is, if we see the increase of the supply, we're waiting for the test that is going to happen on the high-low structurally and on the contraction of the supply. All right, so what do we see here? We see two lows right here. Supply has contracted, and we have a slightly higher low here. So this could be a potential point of entry. But is there anything, guys, in this area right here that just catches your eye of why we would probably not prefer to close, to open this position? Can anyone see that? Okay, so Karen is saying time of the day. What about the time of the day, Karen?
That it's before between 9 and 11.
Yeah, 9 and 11, so it's kind of like a lunchtime. Yeah, I like the comment about the tight spread as well. So with the lunchtime right here, we are actually going to expect that volatility is going to decrease. And volatility has been really high at the beginning of the session. So if there is some kind of reversal, there should be a lot of strength, because we need to overcome this supply on the way up. And we know that after 11, we're either going to have a continuation or a potential reversal. So it's better to wait. And then as we come into this area right here, and it seems like, okay, maybe we have a structure here for the whole day, like a trading range like this, and maybe this is C, and we're thinking, okay, we just need to wait for the higher low and lower supply. Supply is not coming at the level that we want, but it's still a high low. Now, would we open the position here? We probably wouldn't. Why? Well, because we don't want to open in the last, 20, 30 minutes. What if tomorrow morning or after the market hours there is some kind of news or anything like that, and it gaps down on us, or something like that. So we don't want that. The price gaps up. Now there is a lot of supply in this bar right here, and we see that right after, attempts to go up, unsuccessful, and we're just going down. So we still have a very good presence of supply compared to the previous area of the supply. So if there is so much supply, what can we expect? Well, here we consolidated. So what are we going to do here? Probably we're going to consolidate as well. And kind of like the same logic, we want to test this low at the higher low with the contraction of the supply. It comes, but again, it comes kind of like at the weird place where, we are lunching there. So we don't want to do that. And again, we are missing the entry point, somewhere here. By the way, on the daily, you might consider entering on this day. And then the next point of entry for us, the first point of entry, and finally we can find it, happens on a much better gap. This gap is so much different than this one, where on the first bar we actually have a continuation in the direction of the gap, and we have a further continuation in the direction of the gap. Even though supply is present, but look at the reaction here. Relative to the move, it's actually not as bad as we had it here. So look how it comes here. Look how it comes here below 1/2. Here we are probably what, 1/3 down. So reaction is much more shallow. Gap is much larger. There is definitely a change of character on the gap of how gap is, acting. So we are looking for the first 30 minutes of the session. We define the range. Here it is. And we're basically saying that because of this change of character on the intraday action, we are just basically waiting for some kind of intraday reversal, which would identify a point of entry for us. And here it is, this bar right here. And we enter this bar, we could put the stop loss just slightly below it, below the previous low, below the intraday spread range. And we can leave this position on and wait until first until the end is done, the day is done, and until we can make some kind of assessment whether we want to leave this position on or not. So how would we decide whether we're going to leave this position on or not? One of the things to think about here is the whole action on the day. So when you look at the daily, this is the day that it happened, you have to consider a true range for the day, which, this is the close, by the way, which is this. And then the question, is this a significant bar? If this is a significant bar, then our decision is just to leave a position on for a potential swing trade. If that's the case, then our stop loss is going to be left at original intraday stop loss level. I should have written this down. Okay, well, at least, you guys can work on this a little bit and just make some notes. So our stop loss is not going to be below here. It's going to be somewhere here. And we're just going to hope that there's going to be a continuation, and we instantly reward it the next day and based on these 2 days, we're just going to decide that we're going to stay in this position. Now, one of the ways to think about the stop loss movement is going to be all about the idea of the predominant trend. So how would we define which time frame to use for our stop loss? So let's say that we are here at the end of the day and we decided that we're going to do a swing trade. But we still understand that probably we should have the stop loss on some kind of intraday basis, right? So we want a quick swing and out. So we would have to look at the previous instance where the price was going up. So I'm identifying the previous rally. I'm looking at the 60 minutes. And I would experiment. I would put maybe like 2 hours time frame. I would put maybe like 15 minutes, 30 minutes, 60 minutes, and see if I could have one swing in one time frame without any reversals. So when I look at the 60 minutes here, I see that there was a reversal right here. There is a significant bar here, so my stop loss will be here. Then the next significant bar is here, and my stop loss is going to be somewhere here. And I could probably exit either here or on the way out, but basically that was the swing. So 1 hour seems to be working okay, you know, for this type of swings. So I can actually use 60 minutes, you know, to identify where my possible exit out of this trade is. And as we go up, I see on the next day 60 minutes bar here, which is significant bar, then the next significant bar, then the next significant bar, which I could divide into half, and then the next significant bar. And here is the stop loss. I mean, it's been moving like this, 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 then this, and now this. So somewhere in this area, I will get out of this position. And look what their trade we have had here. Here's the trade. Now this trade actually spans through 1, 2, 3, 3.5 days. So that's not your intraday trade per se, but it's a very short swing trade that we've had. Now think about kind of like the benefits of what we've done here with this switch to the swing trade. If we would have traded, we probably would have day trade this day somewhere here, this day somewhere here, and then this day, that would be the trade right here. Now we would miss a couple of spots here. First of all, we would miss this. We would miss this. And then it's not the fact that we would even participate in all of those 3 trades. We might be distracted, you know, with whatever life brings to us on those particular days. We might miss them even sitting there in front of the computer. Also, we could make mistakes with those trades as well. We could either, you know, downsize it, we could be late on the entry, we could be early on the entry, we could be shaken out. So there are a lot of scenarios that can go against us in the execution period. So therefore, you know, if we have just one trade and it carries us through all of these 3-4 days, you know, we are definitely much more confident here, especially on the second day when there is such a big move to the upside, and we're collecting more profit. Okay, let's look at the rest of the trades here. So once we exited somewhere here in this area and this was the trade, we could re-enter this trade because there is nothing really that has changed. We're still in the daily upswing. We're still in the structural up bias, long-term, short-term, very, very short-term, and we're still trading the momentum stock. So the next entry for us will be on this day right here, and that would be, on the intraday basis. And then by the end of the day, we're still probably going to be keeping this position because if we look at this whole day, we're closing above 1/2 of the day. Our stop loss is going to be originally somewhere here, and we're just hoping that there's going to be a continuation. Next day it continues to the upside. We're holding on to the position, and then next day it gaps up. We're continuing to the upside. And we are basically using the same 60 minutes for significant bars. And here is where our potential exit could be. So we can exit on the change of character, and this is the largest reaction since this low right here. Or we could potentially exit on the way out on a secondary test rally. So that's up to you how you want to exit it. I want to concentrate on the comparison between 5-minute swing reversal trades that we could have each day. So each day we could have a couple of trades that are going to go in the direction of the uptrend. Or we could intraday switch to a swing trade. So we had one switch here, and this was the trade. And we made $27.35 in number of points that we've collected here. And the second trade, we are entering here and we are exiting, and I put the exit on this bar right here. So I'm just basically saying that we are exiting on the way up, trying to reach the secondary test high that was created by the climactic action. So that trade was 105.30. Now you might say, okay, well, there is a big gap here, so maybe it's not a fair comparison. I'd say on the contrary, if you're trading the momentum stocks and you're doing that type of switch, this is what day traders are missing. Especially in the stocks, because you're going to have some events in stocks and you're going to have those type of gaps, especially like on the earnings or something like that. So you could trade this day and you still have a big spread here of $20 for the day trade, and you can have a lot of profits here. But consider thinking about, what if I open as an intraday trade? I know that there's going to be a sign of strength. What would the sign of strength be associated with? A lot of velocity, a lot of momentum. How would that momentum be depicted? Either big spread bars or some gaps. So therefore, is this a profitable opportunity for me to make that switch from the intraday to the swing trades? Yes, it's definitely a very profitable idea. So 2 trades only, 2 wins, 0 losses, $132 over collected. And here is the stats for all of the trades. I just conducted them, kind of like paper traded them for this particular move. The rules, we're going to open a position only between 7 and 12:30. So we are waiting for the first 30 minutes to develop. I should have mentioned that lunch hours are going to be excluded. We're only going to go long, no overnight positions for the 5-minute swing trade. So basically the intraday trading, at its purest. And we have, in this area right here, we have 6 trades. And the result here is 11.19. We have 1 loss at the end. And look at what's happening here. The first trade that we've had using this switch to the swing trade is still producing more than twice amount of profits than the ones where we're just trading, trying to day trade each day. So you are multiplying your mistakes with the larger number of trades, intraday trades. Instead of 2, you have 6. You are also minimizing your profit because there are some areas where you're going to have some gaps, plus some signals are going to come a little bit late, into the beginning of the session. You might not come in at the lowest price of the day. On the way out, you're going to be thinking about, where you're exiting, and that's going to be eating up some of your profits as well. So therefore, even on this small example right here on this trade, we could see that it's better at the correct timing to make that switch. The second set of trades, which was done right here in this area, here they are, and we have three profitable trades, 2 unprofitable. I'm actually not worried about, unprofitable trades here. They're very small in comparison to profitable trades. This one was a little bit more than we would prefer it to be. But basically 8 wins, 3 losses for the whole series, $27 collected total. Here, 132. So there is no comparison really. Even if you take out the gaps of, let's say, let's say 610 and here 675. So that's $65. So let's take like $65 away. 65. So that's going to be 60, around $67. Still, when we're comparing to $27, almost 3 times more if we don't count the gap. So I think that this is a strong argument here for us to consider switching to a swing trade at some point when we're seeing the benefits of such switch. Okay, let's confirm this idea with another case study. We're going to look at the Monster beverages, and then after this we'll stop and we'll see if we have any questions or comments. So in this I've presented at the swing workshop, so some of you might be familiar with this. Basically we're looking at a stepping stone reaccumulation range right here. And we are identifying phase C in this area, and we are identifying a reversal. Now with this reversal, we could enter this reversal at the end of the day, let's say at at 28.50. We could go through this whole swing, and then we could exit right here on the sign on the signs of the change of character bar at 40.15. We would make where is it? I think that, yeah, this was this the return. We're entering at 28. Yes, so that was the return. So we are making about 41% on this trade, and it is 112 days that we're in the trade, and our annualized return, and this is the velocity, how I measure the velocity of how much money we're making, how quickly we're making the money, was over 200%. So I always try to look with swing trades on this number or long-term trades. It just gives me an indication whether I was in a trade that was a high velocity trade, and therefore this is efficient use of capital. So that's one of the possibilities. But then and by the way, risk and management, let's go through this too. So we entered the trade at 28.50. Stop loss was $2 below, so our risk is $2. Our exit on average is around $40, and our average profit is $11.50. So our reward to risk ratio is 1150 divided by 2, which is 575. So this is a really good ratio, reward to risk ratio, because it allows us to think in terms of the many number of trades that we're going to conduct like this. And let's say if we are having, let's say, 100 trades, and we have a 50% expectancy. So that means that 50 wins and 50 losses appear on our statement. Then looking at the risk reward, we're saying that 50 trades are going to have this reward, and then 50 trades are just going to lose, and 1 unit of risk is going to be lost. So on 1 unit of risk, we're having 575 units of profit. So I don't want to calculate this exactly, but we basically around, we are above 200 units of profit, which is a really good indication for the system. So the larger, the bigger this number, the reward to risk ratio, the better for the system. Now, for the intraday entry, on the same day, if we would consider intraday entry and we would consider increasing the size on the intraday entry and keeping this by the end of the day, our reward to risk ratio would be 41. Now think about this, 6 of 41. So on each unit of risk that we are having, we are getting 41 units of profit. That's a tremendous average of reward to risk. So how can we get to that point? How can we actually have that type of trade? Well, we would have to go actually into this smaller area right here and then come to the intraday action for this area and figure out how we could possibly intraday trade, and then how we could possibly switch from the intraday trade to opening a swing and keeping it as a swing position. So here are the days under consideration for day trading that we've had with this in this stock in that particular spot. And by the way, Monster Beverages is also and was a momentum stock. So this is the stock that you would be looking for, to initiate your positions, intraday positions. So on day number 1, what we see is, and we're comparing to the lower chart, which is the market proxy, and I don't actually recall to what this is exactly. This is probably Qs right here. So we see on day number 1, Monster Beverages is just going down with the gap so much. So in the first 30 minutes, and this is going to be where we want to observe, any type of actions by the stock, we're definitely weaker than the market. So we're not interested in coming in and day trading this stock on this day. Next day, we see that the first 30 minutes could be stronger than the market, but there is no really any breakout, to the upside in the first 30 minutes. So again, we're going to be inclined not to trade here. We were thinking that this was phase C, by the way, so we're thinking also that, we should, if this is some kind of spring action, we should have some kind of testing action. So the test comes at the beginning of day number 3 with the gap down, and it actually goes below the low that was previously created by the spring. So this presence of the supply and the fact that the price went lower than the previous low again negates everything that we want to accomplish with this stock, So structurally, we just have to wait, and we just have to understand that we might have a trading range right here rather than just a small sprint point and then a test. On the next day, we actually open up quite strong, but we never commit to the upside above the first initial 30 minutes. The market is weaker, but that first 30 minutes, the breakout to the upside does not happen for us. So we don't want to do anything here. Next day, we are gapping up and coming down really fast. The market gaps up and doesn't go down that fast. So we are weaker here, and therefore we don't want to participate. Next day, again, we're gapping up, but quickly going down, whereas the market is holding the gap. So again, we are weaker and we don't want to participate. Next day, the gap up is actually quite successful, and we might consider this, as a potential day for us, to trade. The gap in the market is actually stronger, so that could be the only thing that could keep us away. But even if we day trade, and we say open position somewhere here, we see how the price actually goes down. So we would close this position either with a break even or with the loss, and we would be done for that day. Next day, after the 30 minutes, nothing happens. And then day number 9 is a significant day for us because finally, and we've traded potentially maybe on this day only out of all of the 9 days. Day number 9 is where we're going to be very active. From the beginning, the day starts with the big spread to the upside when the market is much weaker, so we are stronger. So this is the one that we want to choose for our upside trades on the intraday. So the first 30 minutes pass, and we want to enter on the first reversal out of that first reaction. By the end of the day, we see that the price stays up there and it doesn't come down. So therefore, the daily spread is going to be quite significant. This is going to be a significant bar on the daily chart. So therefore, we know that we want to come in on the reversal that would be identified by the significant bar. And at the end of the day, our decision is just to keep this position on. Our original stop loss is going to be somewhere here, below where we've entered. We might have had an addition to this position at some point, maybe somewhere here, so we could actually have a much more meaningful size than just one position. But let's say that we just opened one position, so our size is a regular intraday size that we use. So for that trade, our point of entry is going to be 27.65. Our stop loss is going to be 27.35. Our risk is only 30 cents. So think about this. Before here, on the same day at the end, at the close of the day, our risk was $2. So what would we do with the intraday position here? What kind of risk we're going to have? Only 30 cents, just because we are trading on a smaller time frame. And if our entry is right here, our stop loss is here instead of entry here on the daily, and then our stop loss is here on the daily. So intraday, the risk is much smaller than all of this. Now the question from Karen here is, would we leave the stop loss in the original position we'd leave the stop loss in the original position overnight. Yes, but the question, I guess, more important is where would we leave the stop loss? So let's say at the end of the day, I'm sorry, right here. Why am I doing it here? This is the next day, right here. So this would be the risk for us, if we're doing the just the daily swing reversal. Okay. So the question is, where would we leave the stop loss, right? So we definitely can move the stop loss somewhere here, but the more correct way to do this, because next day you might have something like this, hits you, goes up, is to leave the original stop loss for your intraday position, so somewhere here. And even if you're going to have some kind of move to the downside and then continuation, most likely you're not going to be hit. And the next day was really good for us here. There was only first initial move to the downside. So we would leave this overnight stop loss where the original intraday stop loss was. And what we would do once we switched, we are not going to necessarily use the intraday techniques to move the stop loss. I mean, you can. If you do that, your exit is probably going to be somewhere here. But you can switch to the daily stop loss or to the weekly stop loss, and you basically can catch this whole move to the upside. So if our exit is at the same average in $40, our profit here is going to be $12.35, and our reward to risk is going to be $12.35 divided by 30 cents of risk that we've identified here, 41 units of profits on 1 unit of risk. So that's a very, very considerable number. Now let's put this into the perspective of $100,000 portfolio. So let's say that if my risk aversion is really low and I'm only risking 0.25% per position, so that means that I can only risk $250 per position. And usually retail traders are not like that. This is more institutional type. But you would be surprised that some of the retail traders, I actually like that. I've met people who are using, 0.25%, 0.5%, and there is nothing wrong with that. This is just, the level of acceptance that they have for the risk, and I think it's actually very smart. So how many shares can we buy here, for the risk of $250? Well, if this is the risk in dollar amounts and this is the risk in points, we can buy 833 shares, and we will commit $23,000 of our capital. So our profit on 883 shares with the $12.35 move to the upside is going to be about 10,000 or about 10% in 122 days. We are risking basically $250 to gain 10,000. Think about that. We are risking $250 to gain 10,000, and that is only happening because your sizing here is different than your size for the entry on the daily basis. And the sizing is so much more significant because of the risk. Here your risk is 30 cents on the intraday, 30, and here your risk on the daily is $2. So this difference creates much larger sizing for you, and if you identified that day correctly and you switched correctly and the price is not coming back to your stop loss, then you're going to gain a lot. You just need to wait and exit on the daily or weekly, whatever you decide to do, and you could have that type of trade. Now also think about this 122 days. If you're day trading this stock, how many mistakes you're going to have here? How many days are you going to miss? How many trending days you're going to miss, and how many days, low volatility days you might be frustrated with, just day trading? Probably a lot. Now, what is your maximum risk, right? So we always have to think in terms of like black swan events. What if something unexpected happens and we have a much larger loss? So I always think in terms of, and that has happened to me probably 5-8 times through my career, where you have a position open, you wake up next day, look at the quotes, and then the stock is like 20-30% down. Usually on bad news, maybe earnings related or something else. I'm not necessarily talking about like market environment when the market is in the bear market, so that would be a big mistake. But when we are in the up market and then you're picking the stock and then there is something unexpected happens. And I'm sure that you guys have been in this situation many times as myself, so you know what I'm talking about. So I'm looking at the biggest risk as an overnight gap down. So I'm averaging the gap down to 20% from the price of 27.65 where we've entered. So let's say somewhere here. So the loss on the same amount of shares that we've acquired during the intraday, trade is going to be 4,600 or 4.5% of your equity. So it's a significant number if your risk aversion is so small, because you're losing a lot of units of risk. But at the same time, in the bigger scheme of things, 4.6% loss is actually quite acceptable. If you think about what kind of potential return you're expecting. And then we also have to consider that this type of event is a low probability event. And therefore, this low probability event, or how often is it going to happen? I mean, in my 20 years of trading, it happened to me probably, as I say, like 5 to 8 times. So I'm quite comfortable accepting this type of risk, especially considering the number of trades that I've conducted. And that would be a completely, acceptable level for me. Now, the problem occurs when we are becoming a little bit reckless with this idea and we are on the bad side of the analysis. So we are making a mistake with our analysis and we're coming into the stock that actually is not under accumulation, but maybe it's a redistribution or distribution, different scenarios. So let's say that, we kind of made a mistake like that and we're still going to have the same the same type of risk with the gap down, with the possible overnight gap. Well, first of all, let's look at the profits if we increase the size. So if we are risking 1% or 1,000 out of 100, on the same intraday entry, we're going to have 3,333 shares, and we're basically committing our overall capital, our overall portfolio to this trade. So we can't really go 2%, we can't really go 3%. I mean, you would have to go into the margin requirements, for those of you who are intraday trading overnight are going to be increased. So I'm not sure if you're going to have even that chance. Let's say we're just committing the whole, equity to this particular position. We're just basically shipping it in, um, and it's still a good, um, all-in for us because at the end of the day, we see that we were correct. We were right, and we already have a really good profit. And if the price is going to continue, which is probably a high probability that it's going to continue, we're going to have more profits. So on the 1%, we're going to have 40% profits in 122 days. And that's a big significant number because, if we're going to look at well, this is going to be a 40% as well, but if we're going to look, at the annualized return, over 200% return annualized. So this is a very high velocity trade. And it all starts with understanding the structure, long-term structure, like this, stepping stone, prior leadership, resumption of the leadership, intraday entry, keeping the position on until it's done, and creating a very sizable position based on the initial risk, which is very acceptable by us. Okay, the problem with this increase is, again, the gap to the downside. So if we're increasing 4 times, then our potential loss could be also 4 times more, so could be around 16, 17,000. So that's already a considerable loss. That would be on the edge of saying that we're having a somewhat of a drawdown. But again, people have different risk aversion. And they definitely going to follow different type of styles, on the risk theme. My final thoughts here is that when you do something like this, understand the worst case scenario. Think about any type of gaps against your position. And let's say speculate if, let's say, a 20% gap down is going to happen. Calculate the loss, the potential loss that you're going to have to your equity, and then ask yourself a question. Is this acceptable loss for the profits that I'm expecting? So, and if it is, then you can just go for it. You can also do a different thing. You could, let's say, create a scaling out situation where this is your regular size, and then you're creating another position, and then you're creating another position as the price starts to travel up, and you're just keeping those. So you can do that as well. That might give you a little bit more confidence, but your profit level is going to go down. All right, let's see if we have any questions and comments on this whole theme of switching from the intraday point of entry to a swing trade. So I gave you 2 examples, guys. What questions do we have? What comments do we have? Okay, so nothing coming up. All right, so that's fine too. And by the way, let's just quickly, let me just see where we are. And I'm thinking that maybe we, if you guys are okay with this, we don't have to have this last break. Like we can just go for it. But I'm just gonna put my alarm at 2:49, and we still have about 30 minutes or so. Okay, so a comment. I understand the theory concept is just a case of getting the analysis right. Yes, obviously that would be the case, but also let's just assume that we were wrong in some of the assumptions here. Let's say was this trade. How would the price, let's say that we were here, right? So this is a good point for us to look at. We were on this bar and we were day trading and we were thinking that maybe this was phase C. And then by the end of the day, we open the position here. By the end of the day, we're basically saying we're going to keep this and we're going to switch into the swing trade. So basically the same as here. So where is the mistake? Maybe the mistake was that we are not correctly identifying phase C and it's not phase C. So what would be the consequence of this analytical mistake? Well, the next day, the price goes down. We're still actually okay because our position has been opened somewhere at the beginning of the session. Our stop loss is somewhere here. Then the day after, we have another day to the downside, and here we are really, kind of like already cautious. We see that actually supply is coming in. We see that this was a supply as well. So we actually probably going to exit on that day. So our risk here is going to be probably all unrealized gains that we haven't collected, that we haven't booked, rather than, losing on the gap down or something like that. So we're still going to have a lot of room to get out of the position, especially in the stock that has been exhibiting strength. So I think that the risk is a little bit more than I overestimated in terms of if selection is correct, then you're going to do okay. I think where the risk is that if you're wrong on a stock that gaps down on you next day, that's when you're going to be wrong, in a big way. But think about the probabilities. How many times has it happened to you, Karen? How many times has it happened to you? How many times have you had like opening the position and then the position just went overnight into like 10, 15, 20, 30, 50% gap down or gap up?
I can't think of a situation where it has happened actually.
Okay, so a question for everyone then. How many times have you guys encountered that? How many times have you opened position and then the next day it gapped down on you quite considerably, more than 10%, or maybe gapped up if you're shorting? Let's share here a little bit. And the reason why I'm asking is because I just want to show you guys that, you have to think in terms of the probabilities, right? So we're definitely not in the game of losing our capital. We are in the game of preservation. Our first goal is to preserve our equity, and our second goal is to multiply our equity. So from that perspective, we're definitely going to be thinking risk first and then reward. So therefore, I'm showing you a potential reward with this type of switch, but I want to ask you, and again, I'm not getting any answers here, so I'm assuming that, only me and Kiran had that type of situation where, an instrument gapped up or down on us. Anyone else? I just want to see the numbers. Okay, maybe it's the lunch. Okay, one comment, several times, but not the next day. I would say in 3 days. Okay. Gap against me one day after point of entry, twice a few days later. Okay, so another yes. Okay, yeah, and I mean, what were what were the losses that you guys encountered? I mean, was it like more than 10%, more than 20%? I mean, what was the biggest loss? I just want to see what was the biggest loss. I definitely had the loss that was more than 20%. Haven't had those in a while though. Okay, 20%. Yeah, and that's why I'm kind of like averaging it down to 20%. So again, just depending on your initial risk, you have to think how many of these events you're going to have during the year. Another reply, biggest lost 5%, but twice I added to position and then market reversed in my favor. Okay. Yeah, so you have to think, what's the probability here of this event? And then what is your goal? You still want to, go and create the money. So this is one of the ways, to increase that profitability, but of course it's a little bit riskier. So you might choose to trade smaller period of time. You don't have to trade, for such a long time. You might choose to have like intraday trade to maybe like a couple of days swing trade, that type of thing. And I showed you on the previous slides right here how profitable this is in comparison to just day trading. And you have to understand that you have to have an opportunity, you have to see it, you have to execute on that opportunity. Because if you don't, then it's not going to happen. So hopefully, every time I show this idea, there are a couple of people that are extremely excited about that because they're thinking about, aggressiveness in their trading, and how, to make money faster. So that's definitely one of the ways to do it. Okay, great. Any other comments, question? Okay, one question. Don't we need to consider volume at the point of entry here? I'm not using the volume here, but for sure, Chandra, we would want to see some kind of confirmation. Now, we'll talk about the volume at the end of the session. So because of the different periods during the session, and you already seen this on intraday charts, whether they are stocks, whether they are Forex, or we're going to go into the E-minis, and E-minis are going to have kind of like the same volume structure as stocks. The interpretation of that volume is going to be confusing. I mean, how can you compare the volume during the lunch hours with the volume that was in the first 30 minutes? So that's going to be that challenge that in some instances you're not going to overcome. So therefore, structural analysis is extremely important, and then volume analysis is only something that you would add on the top of this. And then, you could kind of like, use that. I mean, if you think about, again, like a cumulative wave by David, right? So where do you think cumulatively during the intraday session you're going to have the biggest wave? Where do you guys think this highest cumulative wave on volume? Okay, so Karen is saying at the start. Okay, Chandra is saying at the end. Well, both are right. At the start, probably at the beginning of the session, we're going to have the most cumulative volume there. And then at the end of the session, we're probably going to have the second largest cumulative volume. And then everything else is going to be like in that hole between 9 and 11. So how do you actually make a judgment, on effort versus result like that? You probably can't, right? So you have to have a more homogeneous volume. When you go to the daily time frame, that's what kind of like evens it out, because a day is a day, and then whatever volume we had on that day, that kind of like, is going to be the same function for another day. There is no any kind of like huge seasonality there. I mean, we might talk maybe even about fall volatility. We might talk about summer seasonality there, but um, we definitely, that wouldn't be as confusing as like, the intraday session. Didn't Wyckoff use to double Saturday volumes, if I remember right? Kieran, I actually don't know. I've never come up with it. I actually slightly remember something about this, but I can't, say anything.
Yeah, I think I remember it from, was it Reading the Tape, that book that you wrote?
Mm-hmm.
I seem to remember something about doubling volumes on Saturdays because it's only half a trading day.
Yeah, I think that you can do that, right? So let's say on the intraday, how would you do this on the intraday? Would you just double like from 9 to 11?
I don't know, I guess so. I'm not really sure.
Yeah. So, I mean, it's possible. I would advise you guys to experiment with that. Chandra is saying Saturday volumes would double because Saturdays were half days when he traded. Yeah, I slightly recall something like this, but I don't even think about these concepts, that he described, in his book so long ago, and that are not applicable to our current market. But I think it's an interesting idea. I mean, if we would, let's say, double the volume during the lunch hours, I mean, would that give us a good indication? Or not? I still think that the beginning of the session and the end of the session is still going to dominate in volume signature. But again, I would concentrate on the structural points a lot, because volume is going to be confusing with different periods during the session, and you can use it to a certain degree, but structure is always there. Structure is going to be something that you can't escape. You can't be confused that much by the structure. Okay, I think this is kind of like a fun question. But do guys eating at their desk during lunch hour buy more or sell more? Okay, well, I don't know exactly what they do there in New York or anywhere else. But this is such a dominant volume signature for the intraday action right now that it's not changing, and I don't think it's going to change for some time. So even those computer-generated programs that are trading, they're going to recognize the low volatility during that time, and what are they going to do? They're going to shut down as well. So they're going to trade less. So therefore, there is no really reason for us to think of why this is happening, or how could we extract the extra information from that. There is really no reason. For us, the goal is to make money. How can we make money? Well, we have to look at the specific things. If the volume is going to be somewhat confusing, then why would we do that, right? So simplify complex problems and get to the point of easy execution of those rules, and then you're going to be consistent in your trading. So we don't want very complicated system, but at the same time, we want to be a sophisticated traders. Okay, good discussion, guys. Great. Okay, so now what we have, like 20 minutes before the next break. Let's definitely start, and then let's see in 20 minutes whether you want to have a break or not, or maybe we can just like go all the way and just see if we have more time for questions, or even and earlier. So general guidelines and rules for day trading in minis. Again, this is something that I've created for myself based on my understanding of Wyckoff methodology, based on my proprietary reversal techniques, based on my observations about the market and what's happening during the market. So let's explore this. So again, I'm using the TradeView as my software platform. Again, I'm just gonna say for E-minis, I really like it. It gives me everything that I want to have. Now with E-minis, because this is a 24-hour market and it only closes for part of the weekend, we are gonna have a really good data points, and it's not gonna have like the pre-market activity, with the low volatility that we've had during for stocks. We're gonna have actually some high volatility in the pre-US session, and both Asia and Europe are gonna trade those instruments, and they're gonna trade their own indices, and therefore the futures like E-minis are going to be based, the action before the actual US section is going to be based on what other indices around the world are doing. So that creates more liquidity for this product, and in a way it kind of acts as a Forex now. It still does not have the same volatility where it trades like over $1 trillion per day. But it's definitely, when we look at the chart, is much, much better than any stocks that you're going to look at. So what I'd like to do, again, is I'd like to define the pre-market, so pre-US session, and I have this kind of like in this pink transparent box here. This was the close of the previous day. This is the open of the next day. So everything in between I want to look at. And I want to identify the range for this action that we have before the US market. So that's the first thing that I usually do. And where is it? It's definitely not the first. It's number 5 here. Then going through the other rules, and they're going to be somewhat similar to the rules that I had with the stocks. I want to understand the daily swing bias. So on the daily, I want to know what swing are we in currently. Are we in the upswing or are we in the downswing? I want to have that bias right away because the majority of my trades are going to be in the direction of that swing, daily swing bias. And I want to trade a full-size position in the direction of that swing and maybe a lighter position size in the counter-trend moves. I want to also understand an intraday structural position, and based on that, my bias might change. So what do I mean by that? For instance, there is an attempt to upthrust here. So if we have, let's say, our daily swing bias is up, but our structural intraday structural bias is what at this point? Anybody? What do you guys think we're thinking here at this point? Why is that down, Karen? Why is that intraday structural bias down? Attempt to upthrust at the resistance. So we're definitely at the resistance. So we're thinking, okay, climactic action. Maybe this is an automatic reaction. Attempt to go up, secondary test. Secondary test as sign of weakness in B. And then here we are in potential, I'm sorry, what am I doing? In potential upthrust action, still in phase B. And therefore, any attempts you know, to go down will be to go down into potential phase C. So structurally, we know that we might have a move to the downside into phase C. So therefore, our intraday structural bias is down at this point when at the opening of the U.S. session. And we might take the trade to the downside with the full size as a full size position instead of, you know, going somewhat lighter. So we can definitely have a trade to the downside that's going to have a full size. Now let's look at the support levels again here. Look how the pre-market identifies these levels. So what we always want to do is whenever we have some kind of reversal, we want it to be as close as possible to the resistance and as close as possible to the support. So in here we see this reversal right here, and it's just so nice. So our trade is probably, and this is 5 minutes, yeah, our trade is probably going to be just this. And then look how this support level in the pre-market identifies this area so correctly. And it's not a coincidence. If you think about why this happens, think about the US traders coming in, and I mean professional traders, not the public. And what do? They do the same type of analysis where they look at what has happened around the world as they were sleeping, and they identify all of these levels, and they just basically saying, okay, well, we are gonna trade in this between these boundaries for sure, and then maybe we'll either go up out of this trading range or we'll go down, you know, and we'll break out on either of the sides. So when breakout happens, what we want to see is, do we have a failure and coming back to the support again, and this is another trade to the downside, or do we commit, stay above, and then we bounce off the support which acted as a resistance before? And I already showed you that example before, and that was with a stock, I believe. And here we're just bouncing, and that would be a second trade right here to the upside, a continuation above the trading range that was defined by the pre-market activity. So what other rules do we have here? Okay, we basically talked about all of this. Yeah, we want to define the boundaries of the lunch period as well, so from 9 to about 11, like this. And we want to see the low and we want to see the high. And if we are in the position to the upside, which we would be in this area right here, our stop loss is going to be just below this level. And then once we have another point of entry, we're definitely basically committing to the upside beyond this level right here. So the stop loss could be moved here. And then if we just, our intent is just to day trade and to exit, you know, at the end of the session or whenever the signal comes, we're going to be very aggressive with our stop loss going into the end of the session, and we're just going to do this, something like that. And then we would be getting out probably somewhere here at the end. We don't want to open any positions, especially if we just intraday trading and kind of like in the last hours. And even though here, you know, we have a really good move to the upside, but in majority of instances, it's not going to be necessarily the case. So I would be inclined just, you know, to stop and not even to think about those trades in the 20, 30 minutes, unless the trade was opened around like 11 to 12:30, that period, you know, and you're still keeping that trade, then you can definitely, you know, still do it. But to open a new trade, it's either has to be a very quick trade, something like here, or just don't do it. Just don't do it. Okay, so here is an exercise. Oh my gosh, and I kind of went through that. Okay, but let's go through this really quickly again. There are a couple of points that I didn't mention. Okay, so who would like to volunteer from people who said that you know, it's okay for them to give me a release? Let's see. Okay, yeah, Karen, go ahead. You know, I'm kind of like getting used to you talking, so yeah,
Sorry about
let's
that.
do it. Okay, so I'll give you the first one.
Okay.
So this is where the session starts, and
Mhm.
we have the first move to the upside. But would we consider opening a position to the upside here?
No, because we're near resistance and that bar doesn't
Hmm.
close above the local highs as well.
Yeah, we kind of so close to the resistance. Like if this is the range, then we are like what? This is 1/2. We are above 1/2. So we probably would be looking to open a position to the downside near the resistance rather than to the upside. Especially structurally, we're thinking, as I've mentioned, you know, we're in potential phase B here. So any type of reversals are possible near the resistance. So we're just waiting. Okay,
Mm.
so then the reversal of this bar happens on this one. So that would be our first consideration, you know, to open the position. Structurally, we're thinking that somewhere here we're going to experience phase C. So where is our exit and where is our potential another entry?
Well, the exit would be the reversal of the last red bar in that downswing, which
Okay,
is,
somewhere here in this area.
yeah.
Mm-hmm. Okay. And by
And
the way,
then,
our exit here could be, if we're thinking phase C, I mean,
mm,
what are our possibilities? Do we have to wait until the close of this bar?
no, we could just exit near the support.
Yeah, because we're so close to this support, and again, guys, you know, I'm going to stress this out. This support was determined not by the previous day. This support was determined by the pre-market actions from Asia and Europe. And this is just specific for E-minis. So you kind of have to, you know, put this into the notes. But yeah, we could just exit um, near the support, because if we're thinking that this is phase C, then we know that the price should go up after that.
Mm.
Okay, so where is our potential entry here?
Well, it could be on that reversal bar, but
Hmm.
because that down move had been so strong, you might want to wait for a test.
Yeah, and I'm putting here supply increases, but in a lot of cases, I don't want to even look at the volume, especially like with E-minis, because again, very confusing. You have a lot of volume here, a lot of volume here, and then the valley here. I mean, how do you actually, deal with this? It's how do you compare the effort, right? So like, if you're
Mm.
comparing the effort here, then what's happening? Um, let's say on this move to the downside. Well, it kind of like works out here, which is which I wouldn't want to see, but uh, okay, so we might consider opening the position here, but we also might consider that looking at this spread. I mean, look at this spread. What does this spread tell you?
So there was a lot of volatility. There was
There's
a
a
lot
lot
of
of
selling.
volatility. Shouldn't we want to wait and test that volatility,
Mm.
right?
Yeah.
And you could even not look at the volume. You know that the volume is going to be really high here. So where is that test come? You know, it comes somewhere here. It comes somewhere here, right? So
Yeah.
could we find some kind of reversals in this area?
Yeah, I mean, I'd kind of be looking at the first one that you marked, the first test, that
Hmm.
down bar was still quite volatile, the
Right
first one
here.
off the top. Yeah. So then I'd look at the next attempt to go down.
Here.
Yeah, and I'd probably try and open something there.
Okay, something right here.
Hmm.
Yeah, and we still, I mean, this is very close to the support where this is where it's confirmed, you know, with lower volatility and the reversal, but we're kind of like in the middle, and that's possible. Um, I mean, even if we are doing it very mechanically, which sometimes I do, and just sometimes I just feel like, um, you know, I'm just going to trade the swings. You know that you can do that, and especially if with the directional buy. So let's say that intraday structural buys here at the beginning of the session is down, but then daily swing buys is up for the rest of the session. Then basically I'm going to do this. Here is my entry. Here is my exit. Here is my entry. Let's say exit near the support.
Yeah.
And then where is my next exit? It's going to be somewhere here on this bar. So here is my next trade. Then I'm not trading to the downside because after the first structural buys, you know, I no longer have it. The structural buys is to the upside, you know, with the daily swing. So my reversal is going to be somewhere in this area. So probably this bar right here, or these two bars. And I'm just going to the upside until I hit maybe this area right here. So here is my next trade. And then, Kiran, would we open a position somewhere here?
Yeah, so and that's a tricky one because you've got that bottom bar, that kind of pin bar, makes quite a lot of progress and then closes on itself. So probably that next green
Well,
bar.
if we're going to open it up, it's probably going to be somewhere here around this
Yeah,
bar. Yeah,
yeah,
the
that's it.
only thing that we have to remember is the launch. So we either going to have a position already established, so this one, this one, this is going to be the third one. So I mean, depending on what's our intention for this session, do we anticipate a switch from, let's say, intraday trade to a swing trade? So if you anticipate some of these positions might not be closed on the reversals here. And then you can also improve your exit by going to a lower time frame, by the way. This one, you know, depending on how you're going to interpret the launch, you might actually miss, and hopefully you just keep these two positions. But then, you know, if you opened it, where is the exit? Exit is going to be somewhere here, and you still, your bias is still to the upside. And then the next one, where is the next one, Karen?
So it's that big green bar at 12 o'clock.
Yeah, so it reverses the last commitment to the downside. And please note again how nicely we are bouncing off the support that acted as a resistance that was created by the pre-market action. I mean, it's just uncanny for Yeminis sometimes how it works so well. So in here we would be, we could probably, you know, get out after this bar right here, but having looked at how the price behaves here, I probably would change the time frame here from this is 5 minutes, I think, you know, to a much larger time frame, maybe like 15 minutes, 20 minutes, and just, you know, I would try to take this whole move rather than just, you know, be so fragmented here. But if you are, then the next point of entry is probably going to be somewhere here. But again, this is a little bit close to the end. But all of this, you know, points of entry are acceptable, and they are by all of these rules where we are opening with an understanding of the context of what is happening here, attempt to upthrust and then the reversal. We are entering here because we are touching the support, and this is a potential phase C for us. So contextually we're in the correct place and we have the right call. Here we are opening the position after the test with the daily swing bias to the upside. So, all of our trades are going to be to the upside rather than to the downside on this day. And note how we just, profiting from this definition of the bias and definition of the structure when we combine both of them. Okay, great, Karen. Thank you so much.
Thank you.
Let's see if we have any questions. Okay, since E-minis trade 24/7, wouldn't the support resistance change dynamically? How would we determine the support resistance in that case? Okay, Chandra, well, I kind of showed you guys what I do with this. So support and resistance definitely change. And, what I have for myself, and I'm just going to show you like this layout on TradeView. So see, like for each trading day, I define the resistance and support right away before the session. So look what's happening, let's say, what has happened on Thursday. Here is the high during the European session, and then they pushed the price so low that this was the creation of this, level right here. When we came to trade at 6:30, we were right here in this area. So there is a lot of potential to go to the upside. Basically, this is my target right here for any of the trades to the upside. We are still in the uptrend. The daily swing bias is to the upside. I might be thinking here also in terms of a small structure. So climactic action, automatic rally, secondary test, phase A, B, possibly C, maybe some kind of weird upslope in range. So could I have a sign of strength out of this possible C and then a backing up action? Yeah, I can. So how do I manage this? Okay, some supply. I need some testing action at the high or low with the contraction of the supply, which I do have. And then I have the reversal. So this is my point of entry. What is my target? And I'm entering here at 27. So what is my target? My target is going to be all this area right here. So maybe this cluster. So I need to see whether at this cluster I'm going to reverse or not. And I don't see a big reversal right here. I see the commitment further. So I'm going to wait to see what kind of bounce back I'm going to have. I might close the position here and then reopen it again. But on the higher time frame, I might change the time frame just based on how I see the price reacts here. So for instance, for me, this is not that acceptable that if I would open a position, let's say somewhere here, I would have to close it here. How can I go through this area right here in which time frame so that I wouldn't even get out of the position? So I have to find the correct time frame. Let's say I'm going to go 3 times more time frame. Where is it? Oh, right here. And this is another cool feature that I love about TradingView. I mean, I can just like increase the size so easily. So I'm looking at 15 minutes, and the question here is, have I had a reversal? No, I didn't. So I'm actually, we talked about how to define the predominant trend for the usage of stop loss, right? So right here on this commitment, my stop loss is going to move right here, and the price is maybe touching it, but it's not committing below it. So 15 minutes is actually the predominant trend for the move that I can expect, and I can extract this information even before I enter this position. So once I enter, I'm just using this chart to move my stop loss based on this time frame. So my first movement is going to be here on this bar, then here. Then I might consider combining these two bars and moving it here. Then the next bar, because it's such a big bar, I probably would move to be slightly below 1/2, somewhere here. Then the next one is going to be here, again, big bar, so could move it here, could move it somewhere here. Next bar, here, next bar, here, and I'm basically done right here. So this would be the trade for the day for me on this particular day. From 27 to about 41. So that's 14 full points. So that's a really good move on E-minis. Please note again, how did I even think about this target right here? Well, it's all because of the pre-market activity. You can still use the previous day, and actually I do want to look at that, because in a lot of cases it's going to give me some kind of, you know, boundaries. So like right here, I see that where the price is meeting that support. I could also see that maybe somewhere here I'm going to have some kind of support in action. The target is going to be just a cluster and so on and so forth. So you need to look at pre-market boundaries and also the previous day. Another question. So if you decided to convert this to a swing trade, would you move your stop loss back down? Okay, so that's a very interesting question, and let's just see if you guys kind of like caught up with that idea. So what do you think, guys? This is the 17th. Should I keep this intraday entry, and should I switch my whole view to maybe like a swing trade here? What do you guys think? Karen is saying yes. Okay, Min is saying no. Okay, Min, why not? Why not? What's the logic?
Well, I heard you don't move your stop backwards.
Okay, well, I mean, originally, if we're opening a position right here, our stop loss is here, right? So by the end of the day, let's say right here, our decision is basically exit or switch. To a swing trade. So you're saying no, and our stop loss, I mean, if we are exiting, we don't have the stop loss. If we switch, our stop loss should stay here. So if we are not going to do this, then it doesn't matter what we do with the stop loss. I mean, it's going to stay at the same position, at the same level. So we're not really putting it lower, or we're not you know, moving it up to the unnecessary place. Ming?
Oh, I'm sorry. Yeah, your voice is kind of breaking up. It has been doing that for like last hour. I don't know, it's my internet or
My voice is breaking up.
So I didn't hear what you just said. Sorry.
Oh, I'm sorry, guys. You should have told me. Well, so the quality of the audio is bad. Okay, so everybody's
Still breaking up.
Oh, okay. I mean, it might be on your side because everyone else is saying that everything's okay. Usually, you know, people are really, really responsive to that. So if you're having the problems, audio problems, what I would do is maybe like log off, log in again. Sometimes that helps. Or maybe just check your speakers or headset. But People are saying that actually audio is okay. All right. Well,
maybe I'll relog in.
Okay. Yeah, try that. Try that. Okay, so one of the things, okay, so another answer, yes, until the potential reversal area, then go back to a smaller time frame. Okay, so in a way, we kind of like missing the whole concept here. So I'm glad that, you know, this question is coming up. Let me ask you this. Let's just go to another time frame here. Okay, let me just use this. Let's put a mini contract here. Okay, so here's the chart, this fourth one. Excuse me. Let's put it to the daily. Oh, I have the same picture here. I didn't want that. Okay, hold on a second. Okay, well, I just don't want us to look at this. Well, actually, I can do this here. Yeah. It's always good to have like backups. So currently, I'm using TradeStation, you know, primarily for my classes, for any type of swing trading, you know, long term. I'm using stock charts as well as kind of like a very convenient tool, and I'm using trading views. So it's good to have some backups, and trading view I have as a real-time data. So that's you know, definitely not an inexpensive way, but I like to have double sources just in case if something crashes during the day and I'm in the position. I don't want to, I mean, I can extract the quotes from anywhere, even from my cell phone, but I really would like to see the visual picture, you know, and not delayed. So you kind of have to think about this when you day trade. Okay, so I think that we are missing the kind of like the concept here of a switch. So how do I spell it? Why am I forgetting it? Okay, so we were here. Okay, so let me ask you these questions, guys. When would you switch? Show me on this chart, where would you switch? From intraday entry to a swing trade? And maybe this question is gonna kind of like put that final nail that we need to about this concept. Let's try to participate here, you know, with, I want to make sure that everyone is understanding this. Okay, so Karen is saying when the daily is the reversal bar. Okay, why don't we do this when the daily is the reversal bar? Karen, why don't we identify that reversal? So when was the latest reversal? Somewhere here?
Yeah.
Okay.
Yeah.
Maybe we could, I mean, there are quite a few other not necessarily daily reversals that we've had on the move to the upside. Hold on a second. Maybe somewhere here on this day.
Yeah, so that's out of a stepping stone.
Maybe somewhere here on this day.
Yeah.
The day that we were looking at was the 17th. It was this day right here. Okay. Next possible reversals here, right? Then on this day, right here, this day, right here, this day, this day, this day, this day. And we can go on and go on and go on, right? So think about looking at all of these trades, you know, reversals, not trades. Looking at all of these reversals, imagine that you are, first of all, you're day trading each day, but at certain spots, you decide whether you're going to switch your day trading to swing trading just because it's going to be more profitable. So what are those spots? So Karen is very correct. We are going to identify the reversal bars, and this is where we want to convert that day trade into a swing trade. So for instance, if we day traded on this day, and by the end of the day, we are done, and we open a position somewhere here, and our original stop loss is here, based on the reversal, we can leave this position on, and we can exit on the next daily reversal, which will be here. So this is the trade that we would create. On the way up, we can add to the position, we can scale out and do a lot of things. But primarily, you know, your position size is going to be increased here, your risk is going to be minimal, and this is the trade that you can create. This is an enormous trade by day trading, you know, parameters. There is a second rule that we should consider here. So the first one was correct. We're looking for a switch on the reversal bars. So therefore, that question, Karen, whether we should open, you know, a swing trade, keep it as a swing trade here, it's kind of like a little bit too late. You see that?
Yeah, I see that now.
Yeah, it's a little bit too late. What is another rule for us here to consider for the switch from the day trade to the swing trade? What do you guys think? What else are we neglecting here? So whenever we talk about the reversal, we're talking about a daily swing bias. What else are we not taking into consideration? Move out of the stepping stones, okay. How else can we rephrase this, you know, in the terms of what we're talking about? What other bias can we develop? Can we develop a structural bias here? Right? So we have a swing bias, daily swing bias. What about a structural bias? So for instance, right here, we're thinking that this could be first, and we'll have a slide on this, this particular low. This could be phase B low, and therefore the next bias is going to be up. Secondly, this could be phase C, and the bias for the next move is still going to be up. So therefore, this confirms that the switch could be really profitable, and at least at the minimum our target is right here. Now when we go into this situation right here, a lot of the signals could be eliminated. How? Well, we can still definitely have this as a swing trade, but this becomes a change of character which dictates that we're going to have some kind of consolidation. So here we could be just trading, you know, on a daily basis. We don't have to trade the swings, and we could just wait until we have a better indication of phase C, which comes right here. So the structural bias here is going to confirm that we're going to go down. Daily swing is confirming that we are going to go down. And therefore, our intraday position could be held as a swing trade. And the first attempt for us to get out of that on the daily basis is going to be this bar right here, which was confirmed by this bar right here. So here is a second trade that we can do like that. Then we go into the change of character, and we could just day trade, day trade, day trade, and we could create a smaller swing trade right here just based on the resistance and now known support. And then here we could be thinking, okay, what are the scenarios here? We either in phase A, and we're testing the climactic action here. We are in phase B, and this is a secondary test. And if this is a test of the climactic action, our structural bias is up. If this is phase B, our structural bias is up. And if this is even C, our bias is still up. So in all three scenarios, we're thinking that the price at least should go into this area and just retest it. So we can create that swing trade, and until we have the reversal of the swing, which we haven't had, we are going to continue with that trade. So this trade is still continuing, and it just gives you more opportunities to add to the position if you'd like. So therefore, the switch between the intraday trade, the switch from in the intraday trade to the swing trade is always going to be on the reversal bars, or some kind of, reversal bars after smaller reactions. Those are also appropriate, like this one right here, this one right here. And also structurally, we would be somewhere at the area of the support or at some area of the resistance that was created by the structure, and we're probably going to be in phases C. Or we're going to be on the way up in phase D, and then we're going to have reactions and reversals out of that. Does that make sense? Does that kind of like simplifies this whole view? In terms of where we would make that switch, I probably should have created a slide on that, like, particularly where we are doing this. So you want still to be close to the support resistance, you want a reversal bar, and you want structure. So then you can switch it. Okay, great. I'm glad that we looked at that. So now let's look at the examples of that. So this we looked at. Okay, that's great. Okay, so where are we? 3:15. Okay, so we still have an hour and 15 minutes, and then we can stay for Q&A. Okay, let me actually skip this for a second, and then this concept on the switch is, we could look at this really quickly. So, it's actually 6. So this is actually 7. Okay. So let's continue with this idea. Where would we switch from the intraday trade to the swing trade? We're going to look again at the E-minis continuous contract. Daily is going to be used for the swing price structure, 30 minutes for the intraday price structure, and 3 minutes for the points of entry. So here is that recent situation. Again, if we're thinking here on the daily basis, what is happening in this area relative to this low? If this is a climax, then we're thinking either that's going to be a secondary test in phase A, or secondary test in phase B, or phase C. In all three cases, we are expecting a move to the resistance area. So therefore, we are going to intraday trade somewhere here near the support. And once we have a confirmation on the daily that we have reversed, then we're going to stay in that trade until we hit our target or until actual the reversal happens. So let's look at that. Okay. Yeah, I'm kind of doing it backwards a little bit, but anyways, okay. So as we look into this area right here on the daily, this area in the green box, we're seeing some kind of consolidation on the daily basis. So let's look on the intraday. So first move to the downside, change of character, secondary test, phase A, and then not going to spend a lot of time here because we're actually going to do this next. We see phase C here, and on the day, this was the day with the potential change of character, and we defined it. And for those of you who attended the market outlook session, we actually kind of nailed this. We nailed both the climactic action and the reversal near the support. So this was a change of character on the intraday, and then the next day, the opening of the US session was here. So there was a gap between the close and the opening, of the US session next day. And this is the action that has happened in between. So the opening, because it opened with the gap, it kind of confirms already that this not just was a potential change of character, but that it was a change of character, and now we're confirming that. So therefore, any of these intraday positions that you're going to open, if the day is going to be profitable and it's going to be a significant bar, you can keep those positions and you can switch to a swing trade. So let's look at the points of entry. So this is a 3-minute on the same day, and we're looking at the opening. Our bias is already up. Our daily swing bias is already up just based on the gap action. And then our structural bias is up based on the idea, and we might be wrong in our analysis. We don't know whether it's still A, B, or C phase. But in all three scenarios, our structural bias is up. So therefore, if we're going to have a very good day, then, it doesn't matter. We are still going to stay in this position because whatever this is, B, C, or A, the price is still going to go up. So we are just looking for a reversal to the upside, which comes on this bar right here. It also acts as a change of character here. We enter here with the stop loss here. We could add to the position here. After 11 o'clock, we could add to the position here as well. And by the end of the session, we see on the daily that this was a really good trending day. This was a reversal day. So again, could we open the position, or could we switch to the swing trade? Yes, we are satisfying the reversal significant bar. It's near support, and structurally, we have a bias to the upside. So that was a perfect day and the perfect intraday to the swing trade switch. Okay, any last questions or comments on that switch? There is a reversal bar just before 7. Would we ignore it because of the time? Just before 7. This one?
Yeah.
Yeah, we can be caught up in this. Absolutely. Yeah, I actually even did not see that when I was preparing this slide, but you're right. I mean, you might consider that as a potential reversal. So there might be a loss here. And then you still have to go in right here. It's not necessarily the largest reaction to the upside that we see here. So this is definitely much larger. So you can also, as a rule on the entries, wait for a change of character first and then a test, especially with some supply coming in. Or another way how to deal with this is I'm looking at this as a high point for me, right, on the swing to the downside, and I see that this has been reversed as well. So I can anticipate that there could be a fake reversal here. So instead of using 3 minutes, I can go, and this was on 12th. And instead of 3 minutes, I can try and use 5 minutes. So let's just see first the 12th. Yeah, but that was February 12th, right? I probably should use the trade station, would be easier. Okay, so this is March 10th. Fourth, 10th. Okay, so we're somewhere here. It's okay. So this is 5 minutes, so let's look how it unfolds on the 5 minutes here. Okay, so this was that high, and we still would be reversed right here. So even, 5 minutes is not necessarily enough. But see how with 5 minutes we're already not reversing here? So you just have to go maybe to a time frame where, this reversal is negligent. So let me just do this in a different way. Let's go to like 15th and let's change it to 10 minutes. And here it is, right here. This was the high. And here we don't have a reversal, right? And here we have a much, much cleaner point of entry right here. So I think that, 10 minutes is going to work out, much, much nicer, in this case. But your risk is increasing right here as well, because your point of entry and your stop loss are going to be, separated more. Yeah, all right, no worries, Karen. Okay, great. Let's see, any other questions on the switch? And a lot of you during the introduction have mentioned that I'm swing trading, but my swing trades are somewhat of a shorter term, 2 to 3 days. So therefore, I'm kind of like inclined to look at the date at the intraday data. I'm also thinking about better entries on the intraday, and that's all relevant. And the way how you develop this technique is you have to be comfortable with the intraday interpretation, with thinking about particular biases, on the specific swings, and then how be comfortable with the conversion to the swing trade. So if we want to add to our swing positions, we have to wait for the higher time frame structure. Okay, so that I don't quite understand. If we want to add to our swing positions, we have to wait for the higher time frame structure. Actually, on the opposite, I mean, if we are looking to let's say that we've opened an intraday position right here, and we made a switch here. So now we are in the swing trade. How do we add to that? Well, obviously we're going to hesitate here in this area like we did, with the market outlook, but then right here, if we are opening a position on this day, on the intraday, that would be an additional position, and our stop loss is going to be somewhere here, so we just add it. After another reaction, we are opening an intraday position here, and we're just moving the stop loss right here, and so on and so forth. So, I mean, you could actually, develop a case where you intraday trade on any significant bar, and you keep that position on. Intraday trade, keep the position on, and stop loss, and you just move in the stop loss. Keep the position on, move the stop loss, and so on and so forth until the stop loss hits you. And in this case, it's going to take a while, and probably it's going to start hitting you. Somewhere here you're going to start thinking change of character. So on the contrary, instead of going to a higher time frame, to have a much larger size on the swing trade, you want to go to the lower time frame and day trade the days that are going to become significant days, and then keep those positions, and that's going to increase your size. Yeah, was that what you were asking, Karen? Yeah, okay, great. Okay, let's come back. Okay, another question. Could we switch intraday positions based on daily VPA too? Yeah, that's an interesting question. I kind of was thinking about this as I was preparing this material, and you could see that I'm not really using a lot of volume on the intraday, and that's just because, and look at this. I'll just go to maybe like 15 minutes. In a lot of cases, we're going to misinterpret the volume. It's just going to be the case. I don't really see a lot of kind of like clear-cut value here, but definitely there is a lot. I mean, when you have a situation like this, when you're comparing the effort, okay, so this is effort versus this result and this result, you obviously see that there's going to be a continuation. But how about this? We have one bar at the opening that has the largest volume, and then we are moving to the upside, but the volume is contracting. So what does it mean? Should we, is this an ease of movement, or is this just a function of opening volume versus just, a regular volume between, like 6:30 and 9 o'clock? Having said that, I mean, I encourage you to use the volume signature, and to develop that understanding. Probably at some point, we'll dive into that. But, for this session, I kind of wanted to concentrate on much more, consistent tools rather than inconsistent tools. And Karen is saying I meant using the volume on the daily chart. Oh, okay. Yeah. Well, that for sure. Yeah. So this we want to use as much as possible. And you can use the VPA features like, I'm liking HDSI right now. Their VPA features, some of the catches that they had recently, just like, kind of pleasantly surprised me. So you can use that. And definitely the volume analysis that we do on the weekly basis, yeah, that should be done. Do you swing back to the intraday for exit? That's a very interesting question. So one of the things to consider, you know, when we are close to the end of the swing, is to switch from the high time frame to the lower time frame for a better exit. And that's a very, very good idea. And we've developed that in the advanced Wyckoff course. We've talked about this for years. The problem is understanding of where that switch from high time frame to lower time frame should happen. Why? Well, because you know, you kind of have to identify that there is a potential end of the move. So whenever you are in the range, it's kind of easier. So let's say that you develop the swing trade right here. You know that it's going to be a very small swing trade because you are in the structure here, and you might have potential one more move to the upside before we go to the downside, just based on the idea of the structural analysis right here. So how to identify where the price is going to start reversing? You can use different concepts. One of the things, easiest things, is just to think in the trading range, everything is going to be bound by the support and resistance. So here I'm putting the slope and resistance. So therefore, when I have the touch, I'm looking for any type of the reversals. So let's say near resistance, look for reversals. How would this reversal come about? Well, usually everything starts with the change of character. So on the lower time frame, you're going to be looking for the change of character somewhere here. Actually, it's going to happen right here first, and then you're going to try to get out on the way up after that change of character. And that's basically what the only thing that you can do. So use your support and resistance as targets, use your structural understanding as understanding of whether this is going to be a big move or whether it's going to be a smaller move. Use the swing reversal, use the change of character. But, you know, if you could identify that we are close to the end of the move, like right here, I mean, this bar is the biggest bar out of all of the bars that we're going down. So is this a climactic bar? Yes. So if this is a climactic bar, can I go to a lower time frame and exit there? The same was here with this bar right here. Now let me just show you how you would do that. So this was August 24th, 15. Okay. So here is this climactic action. So during this, was it the day? Yes, 24th. So as you start to recognize, you know, during this day, during previous day, and then during the Asian and European sessions that we are going to have that climactic action, you want to get out at a much better rate than just the reversal, let's say, on the daily. You can potentially recognize climactic action, change of character, and then get out on the way down. That's a possibility as well. But how aggressive this is going to be, I mean, this is like 100 points, so you don't want to miss that type of chunk. You know, and what if it's going to go even further? So you're looking at the previous swing to the downside, and you're trying to find the best time frame where predominant trend is not going to be, you know, reversed, and you're primarily looking at this previous swing to the downside. So 15 minutes works okay, but maybe 10 minutes would work as well too. And 10 minutes is not going to work, so I think that maybe 15 minutes would work. Or you can start the session, like you're starting it here at 6:30 right here. And you can look at this move because this was the move that actually preceded. So this was the move prior. So you already have a lot of, European session moving the price down. So you actually have to look at this one. There is a little bit of the reversal right here, but everything else looks okay. So 10 minutes would be actually quite fine. You can actually go back into 5 minutes and just see what if, 5 minutes, would that work? Actually, 5 minutes would work well as well, except for this reversal right here. Everything else was okay. This was not reversed. This was not reversed. And then you would go, and this is 1/2. So by the close of this bar, here is your reversal. So this is probably one of the smallest time frames where you could within the contextual understanding that we might be experiencing the climactic action, you want to get out as soon as possible. Actually, I've traded quite a few market climactic actions. Those are a lot of fun, but you have to be really quick, and you have to use a much, much smaller time frame. So you could get out at 1835 maybe, instead of waiting for the change of character and getting out somewhere above 1900. You can also use just this swing to the downside if you're recognizing that this is a climactic action, and this is a big if, because if it's not a climactic action, then you might be wrong there. And you can go to a smaller time frame just for this swing, and we see that 5 minutes worked well, but you can also go to a smaller one. And even on the 3 minutes, you can do it at a much smaller time frame. I think that even 1 minute is going to be okay here. Is this the one? Okay. Yeah, even 1 minute is actually fine. Looking at the last swing again, you have to recognize that this is a climactic action. So you're going one by one with the significant bars, and this bar right here is a change of character. So your exit is going to be even prior to that. So yeah, you can do that, but you have to be correct on your assessment of the structure. And if you're not, then most likely you're probably gonna end up closing the position either too prematurely or too late. Okay, good questions. How are we doing on time? So we're like 50 minutes away. That's great. So let's start the next portion of our workshop. And guys, let me know if you want to have like a 5-minute break. That's fine, but if not, then we can just continue. Okay. Everybody seems to be okay with that. Oh, a 5-minute break. Okay, yeah, absolutely. So let's and then I'm thinking, 5-minute break. What should I do? Should I send a new link, or could we use the old one? Let me just see what's happening there. Where's the link before you go, guys? Okay. You know what? Why don't we do this? Why don't we go on a break, but I'm not going to stop the recording, or I'm going to stop and then I'm going to restart it, and we're going to use the same session. Yeah? Why don't we do that? So let's have 5-minute break. Let's come back at 3:45, and we're just going to have, the recording going on, and that's it. All right. Thank you. Okay, guys, I'm back. Let me know if you're ready. All right. Okay, well, I guess we can go, yeah? Okay, so here is an exercise that we're gonna do, and this exercise, again, is gonna be based on E-minis. We kind of, in the same situation right here with this trading range, and we looked at this trading range, but I want to do this a little bit as an exercise, kind of like to develop this nonlinear understanding of, you know, what we can do during a particular intraday session in the structure that is much more complex than just like one day. So again, give me your name for volunteering, and I'll unmute you. And while you're doing that, let's just, let me just kind of like refresh your memory here. So at point number 1 right here, we are thinking about all of the potential scenarios here. Secondary test in phase A, secondary test in phase B, or could this be phase C? Now, all 3 scenarios suggest that we're going to go up and we're going to retest. So we want to look into this structure right here, and we want to go day by day and see what kind of trades potentially we're going to encounter and we could potentially have. Okay, so volunteer, please. Okay, Karen, let's go. Yeah, no reason to wait for anyone else. Okay, so here is our first day, and this day is going to be this big day right here, with this tail. This is where we are, and this is 30 minutes, E-minis, and this is our US session. Well, first of all, let's just think what kind of daily swing buys did we have coming into this session?
That was down.
Yes, so our buys was down. So our intraday trades primarily going to be oriented to the downside. We would be looking to enter to the downside. And here I see 2 trades, 1 and then 2. And we probably not going to catch this move to the upside if we're thinking about just, one bias to the downside. We might have a very light position to the upside, but we might not even think about, this this type of trade. Okay, so but this move to the upside from 1 to 2, what is it? I mean, how can we interpret that, and how could we label that?
So that looks like a change of character, at least from the recent high on that chart.
Yes, from recent high, we're having the largest reaction to the upside. Spread is increasing, and it's a definite change of character. If this is a change of character rally, then what is 1 and what is 2?
So 1 will be a selling climax and 2 would be an automatic rally.
Okay, so we are adding the contextual interpretation to the data here that we're receiving. And then point number 3?
Secondary test.
Secondary test. Right away, could we put the boundaries for the trading range?
Yes, so from a line from 1 and a line from 2.
Okay, so here we are. We ended up our session. We had 2 profitable trades here to the downside just based on the bias. What is our intraday bias for the next day based on the Wyckoff labeling that we've done? What could the price do here at this point?
So if it reverses this downswing, which I don't think it's done yet.
Okay, so let's say that the price goes down. What happens next?
We'd expect it to test that support and then go up to resistance.
Okay, so some kind of reversal here. So this could be a trade for us if it happens during the US session, because we only trade the US session, right?
Yeah.
Okay, what else could happen? Could the price go up?
Could go up from here, yes.
Uh-huh. And then would it reverse near the resistance?
Yes. Secondary test, so yeah. So that would be a test in B.
Yeah, so something like this, upthrust action or a test in B, and here a secondary test in B. Actually, let me just not put the secondary test here, but just upthrust in B. Again, these are two possibilities that we might have if it happens during the US session. So we might have a situation when the price goes up, touches the resistance, reverses, and this reversal is going to be an indication for us to establish a position to the downside. And we can do this because the daily swing bias is to the downside, and then intraday swing bias is to the downside as well. Near the support, because of the contextual interpretation of this is a secondary test in potential phase B, we know that from here the price is going to have a bias to the upside. So therefore, we might also open a position here near the support. Okay, great. Let's see what has happened. Okay, so that was actually, oh, I see how I'm doing this. Okay. This is what happens next day. So this rally right here is the end of this rally.
Okay.
Yeah, and then we're going into the Asian session right here. Here is the Asian session. Then we're going into the London session right here at the top. And then we're starting the US session right here. So let's look what has happened in the pre-market activity. First of all, we've talked about two scenarios. One was involving the resistance right here, and one was involving the support. So we'll come back to the support here, but here at the resistance, we are trying to upthrust, failing. We are upthrusting, kind of like an upthrust action. We are reversing right here. If we're trading during London sessions, this is our point of entry. Would you say?
Yeah.
Or another attempt to go up, another failure, and then probably somewhere here another point of entry. Now, our at this time when we open in these positions, Karen, where do you think our target will be?
It should be back down to the base of the change character, to the selling climax.
Somewhere here?
Oh, I was thinking lower, but yeah,
well, this
maybe
is
it
the
would be lower.
previous day, right? So
Yeah.
by this time, by this point of entry, the boundaries for the pre-market action is going to be defined like this.
Yeah.
So this is going to be our target. So somewhere here we would be looking to exit or some kind of reversal. Price goes down even lower, there is no reversal. So I mean, we're still going to be in this move right here. Then it doesn't reverse on the next bar, tries to go up and reverses finally right here at the beginning of the US session. So at the beginning of the US session, where are we?
We're down at support.
We are at the support, so that's great. Anything around support and with the reversal characteristic we want to consider as a buy. But what is the structural bias for us right now?
So that's a buy. The intraday structural is a buy, is up, but the daily is still down.
Yeah, and the daily swing bias is down. But because the structure, dominates the daily swings, on the intraday, we could easily have this trade and open a full-size position here. So it happens near the support, perfect structural position for us. So we open the trade on the reversal, and we continue with this trade. We're moving the stop loss like this, maybe this, maybe this. We might get out here, or we might just, wait for the confirmation. Again, upthrust happens. Again, which phase are we in here in the upthrust?
At least B.
Yeah, at least B, or we are possibly in C. In both scenarios, what kind of bias are we expecting for the next move?
The down bias.
Yeah, the down bias, because if we are in accumulation in B, or let's say distribution in C, in both cases, we're going to see some kind of movement to the downside. So we can actually open a position to the downside on the reverse and after, resistance. By the way, by this point of time, when we came to the US session and we had this first successful trade, our pre-market boundaries were defined by this point and then by this point right here. And look how nicely we're just hitting it. It's just amazing how sometimes it just works like to the last, point right there. Okay, so the reversal is going to happen on this bar and we're going to go short, and then we're probably going to exit somewhere here. So that's our next trade. We might miss the trade to the upside right here because we're kind of like not anywhere near the support. We might consider, because just of the bias more to the downside, short it again. So maybe somewhere here or after this failure. And then we're probably going to get out somewhere here. Can we open a position current to the upside right here?
We can, yeah. We're nicely by the support level. So.
Yeah, we are somewhat close to the support level. This is a slightly higher low. We're still thinking whether we are in B or whether we are in C. In both cases, the price is going to go up. So somewhere here on the reversal, we can open the position. And again, our target is going to be all this. And it comes and it reverses again. And here already too late to open any new positions. So if we're just intraday trading, we are going to just, close the positions, any positions that we've had, and not open. So, and this is, where the reversals happen and where potential points of entry are possible. Okay, so currently we have this picture, this long-term intraday picture on 30 minutes, and we're entering on 5 minutes. So how can we interpret what is the current daily bias?
I think it's still down, but I'm not sure.
Okay, I'm going to give you a clue here.
Thank you.
So this was day number 1, day number 2, 3, 4. So until day number 5, we don't have any change of confirmed change of character.
Okay,
so it's all going to be down, 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 and then potential change of character, and then confirmation.
Yeah.
Yeah. So it's going to be down, down, down. Okay. So how do we? So this is down. Okay. Great. How do we interpret points number 1, 2, and 3, and how can we label those? We already know what has happened here, so that gives us a lot of clues as to what's going to happen here.
So these are, I was going to say they're all tests in B, but 2.
Mm-hmm.
I mean, we might.
How does this act?
Large,
How does this act? Goes up, goes back to the trading range. Goes up, goes back to the trading range. Goes up, goes back to the trading range.
Yeah, I was wondering whether 2 could be phase C, but that would make phase B really small. So
exactly. And C, now we're thinking here, if we're thinking this is C, then B is really small, and we don't like that. B is smaller than A, so we're probably still in B here. We want to develop B that's going to, at least exceed phase A right here, right? Maybe like by a factor of 2. So if we're still in B, then point number 2 is what?
An upthrust in B.
Upthrust. And then 1 and 3?
They are tests.
Yeah, secondary tests in phase B. So what can we expect from here?
I guess we'd wait to see what happens in this little trading range that's forming. if it breaks up, then maybe we could expect an upsloping trading range. If it breaks down, then another test of the support.
Yeah, if the price goes and reverses near the resistance, and that happens during the US session, then we could short this because we are still in phase B, right? And the bias would be to the downside. If we're going down here and retesting the support, then this still could be a secondary test in B, and therefore we might trade to the upside. Or this could be a potential phase C, and we're still going to be trading to the upside. So depending on where we're going to end up before the US session, we could figure out, what's going to happen next. Or at least, give us some kind of, heavy bias to one way or another. Okay, so here's what has been happening. Where were we? We were somewhere here, like in the middle of the range, and then it goes up and it creates this type of pre-market, boundary right here. And then we start right here.
That's awkward.
Yeah, this is a little bit not a convenient place because we're in the middle here, so we're not necessarily close to any resistance or any support. We might just open lightly here. I think I put a point of entry right here on the next slide, but it's not necessarily going to be the greatest point for us unless we are going to continuation to the upside. We might be thinking here, and I'm just thinking out loud, that with this type of move to the upside, there is a lot of push to the upside, so we might actually consider this signal as a continuation of that potential push.
Okay.
Okay. How about next? Well, next one is kind of obvious, right? So we are upthrusting and reversing.
Mm-hmm.
So this trade, we could consider this as the first target, this as a second target.
Would you wait for a test of the upthrust, or would you just enter on the reversal?
I would enter on the reverse, because you're thinking about 9 o'clock that there's going to be some kind of, slowing down. So the volatility moves are going to happen before 9, and see how, we kind of like not doing anything between this period. So you wanna capitalize on this move with this target right here, and that's enough target here. So 67 to about 54. That's more than 10 points. And usually, whenever you have a 10-point move in the minis, that's a good move.
Okay.
Yeah. So move to the downside. You might consider again, kind of like if you've seen this, but then again at 9 o'clock, you don't want to initiate any extra positions. And then once you hit 11, so right here, then in this area you definitely can open a position. You had one failure, second failure, third failure right here, and after 11, you're most likely going to have a continuation of those failures. So opening here, maybe somewhere here, and going just into the close. So let's see how I interpreted that. Okay, for some reason I put all of this. I probably should not do that. Let me just do this. Let me get rid of this one and this one. Let's just have one bias here to the downside. Okay, and that confirms both the bias to the structural bias that we have based on the intraday structure, and also it confirms the daily swing bias. Okay, next chart. So this is the action that we've had during this session, and we've seen that this was just another upthrust. The price came back to the trading range and came down. So how would we label, let's say, let's not label point number 1, let's label point number 2, and possibly let's talk about number 3.
Okay, so 2 is another upthrust, we know that.
Okay.
it's still a bit tight to be in phase C. So I'd say it's
Yeah, but we're definitely moving down, right? So it's like there
Yeah.
is some kind of movement closer to the support area. So if this is accumulation, then we would be expecting phase C, maybe something like that, and then, you know, the price going up. So that would be the most preferred scenario. So we have to see where we are going to be at the beginning of the US session. Please note, guys, that we are so limited as day traders, you know, as to when we trade and in a way what we trade, right? Because as we're looking, let's say a big move has happened here, relatively good moves here for the intraday, but then what kind of moves do we have here? Okay, well, maybe these two moves, maybe one move to the downside, and you kind of have to interpret it within the larger structure of what is happening. Here, maybe two moves, but not a big move. By the way, probably here, again, in the upthrust situation, we could extend this trade to the support level, but then again, you don't know whether it's going to go there or whether it's going to reverse and try to upthrust again. So you kind of taking that risk. Okay, let's see where we are before the US session. So we were consolidating right here, and then I see that we actually went lower and below the support. So this was probably somewhere at the long-term support right here from the previous chart. London session again is pushing the prices down. So sometimes, you know, you really have to understand, you know, what session is doing what. Where is that effort coming from? And we see that the boundaries were created by, you know, this action here and this action right here, coming in at 6:30. We just had this move to the touch of the support. So basically all of it is just support level, just a huge big support level right here. And we're coming out of that. Is it possible, do you think, Erin, for us to open a position right here at the beginning of the session?
Might consider that it's too late, but if we see that as a structure, then that that could be some kind of backing up action and coming out of it. So yeah.
Yeah, I was thinking the same way. So phase A, C, and then we are kind of like coming out, you know, we could use maybe a slope right here. And we have relatively enough target movement, you know, to 1840 here from 1820. So that's 20 points. We definitely can participate in that. Enough room for that. And we would be getting in somewhere here, and we would be getting in probably somewhere in this area right here. So that would be a really quick trade. We would be thinking that, was this phase C, or should we expect during the US session, you know, US traders creating its own kind of like phase C? Usually, when we have, let's say, kind of like a move like this in London session, US traders are going to try to push it down to accumulate here and then push it in the direction of the London session. Why? Well, because they want to get in at the best price. They want to get in at the better price than what it is right now. So there could be some fake moves at the beginning of the session. Okay, so then we might miss this opportunity right here because we're not really, you know, close to the resistance, but we're definitely hitting a support right here. We're hitting a support right here, and we're thinking that this is phase C, you know, on the larger intraday structure, you know, the one that we anticipated. So what is our bias here? So the daily swing bias is to the downside. Karen, what is our structural intraday bias?
Well, that's up because we're at the support.
Yeah, we're near support and we are in the potential phase C, so it's going to be up. So we're looking for any of the trades near the support area that are going to have some kind of reversal. So here is our first reversal, here is our second reversal right here. We could take both, and at the end of this day, this is how it looks right here. So what do we see here? Bounce of the support, tail for the daily spread right here, which shows some demand coming in. We see that in the volume signature, so both supply and demand are increasing, and I would say that supply and demand somewhat equal. So we're looking for a confirmation on the next bar that indeed was a change of character and this is going to be a reversal. So with that understanding, let's look at the intraday structure of what has happened. And I've listed, potential reversals here. Here is the intraday structure now. So how would we label 1 and 2?
There've got to be springs in phase C.
Spring, and then 2 is what?
Test of the spring.
Test of the spring. Okay, and if this is C, then what do we expect next day? I mean, what kind of
Expect a large and quick move up, committing above resistance.
Okay, so let's start with the intraday structural bias for the next day.
So that will be up.
Up. Okay. This one is going to be a little bit trickier. Daily swing bias. What do you think it's going to be?
Technically it's still down, but you could put that it's changing.
So at the beginning of the session, we probably still down because we need a close as a confirmation on the daily that it's going to be up. But if we are trading intraday, and imagine if we are opening position at the beginning of the session, and then by the end of the session we already have a close on the significant bar that day, then we kind of would waste that opportunity. So we want to trade in a potential directional daily swing bias, which if closes as significant bar, the bias is up. So we want to be aggressive on the way to the upside if we have confirmation signals. And we see that at the end of the session on the potential phase C here and the spring, the Asian session and London session actually gives us a gap before the US session. This is the gap right here. So does that confirm that the daily swing might be, switching from down to up by the end of the US session?
Yeah, especially like if it doesn't try to fill the gap too hard and then goes on up.
Okay, so we are coming in with a very heavy daily swing bias potentially up, and then intraday swing bias based on the structure is definitely up. Okay, so what would be our points of entry here during the US session?
So that there's obviously a first change.
Sometimes you still have to use this.
So that then it looks good.
Yeah. Sometimes the highs of the previous sessions are actually quite important. If you see that the price is just like respecting it, most likely, I mean, where the traders are going to take this? They're going to take this to the area where there was selling, buying, selling, so selling, then buying, something like that. Okay, great. So somewhere here, our first entry, then what does the price do near resistance?
Breaks and commits above it.
Commits above it, stays above it, right? And then we're coming back slightly below, but then on the high low on the test here, we're just like so good. We're just basically bouncing into the support which acted as a resistance, which is a really good strong sign based on the pre-market boundaries that we've created. Okay, great. So would we open a position here?
Yeah, definitely.
Yeah.
And it's after 11 as well. That's really interesting.
After 11, our boundaries for 9 to 11 is this, and we're just like, trying to get above. By the end of the day, on the daily, it confirms that this was a reversal. If this is a reversal day, plus we have the daily structure is telling us that we are either in a secondary test, it's either secondary test in A, B, or it's just phase C. In all of these scenarios, the bias is what?
That's up.
Up. Okay. So reversal, day, first time when we day traded, could we leave it and switch it to the day, to the swing trade?
Yes.
Yes, and let me show you guys so that everybody would follow this of where we are on the daily. We're trading this day right here, and we are at the close. So here again, this switch, right? Switch from just intraday trading to a potential higher target based on a larger structure and based on a swing reversal.
So with our 2 entries on that day, would we have the stop loss?
We could have 2 entries there and still be okay.
Yes. So would we have our stop loss under the second entry, or?
I would, in these cases, what I usually, my preference is usually just load up here and just to see how I'm going to finish the day and make that decision here. But if you're scaling in and you scale in, position number 1 here, position number 2 here, what I would do is I would just keep the stop loss for each of them.
Okay.
And because if I'm hit with the last one in, first one out, I still have a profitable, second position. And unless something I see that I need to close the position, this still could work out. So you could keep both of them. Okay. And then this is where we are, with the whole structure. And see how, again, US sessions are so limiting in terms of what we can do here. So this was a great trade to the downside if we understand the structural context, and it was during London. This was a good trade also, within the context of where we were. This was a perfect trade, initiated in London session. London. Then this move right here is also a little bit telling because, we reversed on this bar right here, so we're probably going to continue. So this also could be could have been interpreted much, much better. And then here is another London push. So European sessions were leading here as to, the directional buys, both structural and the daily swing. So it's just amazing how it just happens like that.
So on that last day where we had our 2 entries, when we look at it on the 30-minute, we actually look like we're close to resistance now. So would that be a reason not to enter?
In the resistance, we would have to consider the whole cluster here, obviously, and then this also becomes a cluster, right? Because we have upthrust, we have automatic rally. All 3 points are creating that cluster. So this was an easy entry right here. This was an additional entry. So we're still before the first resistance, so I wouldn't worry about that, especially on the day that is finishing like this, you know, and it has just like a big, big bar after the day like this. So that's just such a confirmation that we've overcome, that we've reversed, and plus it's so early. It's the first reversal. It's like the price really should not go back that much right here. But if it does, well, then it's just a loss.
Yeah.
But in a lot of cases, I mean, if you look at the daily, you know, it's going to work out so nicely. You know, whenever we have that. So reversal, continuation, or continuation even more. Again, at the correct structural places, right? Reversal, and then we have such a great trade right there.
Cool. Okay, brilliant. Thank you.
All right. Okay, guys, questions. Let's see if we have any questions, any comments. I know it's a lot of material, and for some of you, you know, there could be this feeling that, well, I didn't look at the market this way, you know, this is something maybe a little bit new, you know, even though the concept seems similar, but the way how we approach intraday trading is distinctly different than the swing trades that we've been discussing for so long. So there might be some kind of like, you know, even resistance that, you know, you feel inside, or some hesitation. So what I would suggest, and, you know, I'm done with all of the material and we're going to go into the Q&A session right now. What I would suggest is, you know, don't rush with any assumptions, you know, let it kind of like, make it like, you know, be there in your mind and think about this, right? Come back to the recordings, watch them again, maybe like in a week or two, or even in a month. And these recordings are all going to be posted, you know, in a week on our website. So think about this and think about how you can use this in your own trading. How can you, for instance, if you're looking for that intraday entry points, you know, what are the spots that you're going to be looking for to intraday trade that based on the daily swing? You know, we kind of identify those places where this type of trades are going to be most beneficial. So you have to be near the support or near the resistance. You have to have a confirmed reversal, and your preference would be to anticipate this reversal, day trade it, and then leave it on once you have a confirmation by the close. Anticipate, day trade it, leave it once you have a confirmation by the close. And of course, you need to understand the structural scenarios right here. So here it was, you know, more evident that was phase C. Here, I was making a mistake there, you know, in terms of what phase it was, but I was not making a mistake in terms of what kind of swing I'm going to anticipate here. So I might be wrong in my analysis, or I might be confused with the analysis, you know, structural analysis, but I know what kind of swing I'm going to expect, and that's what you're going to use as a trader. And when you identify this type of spots, that's when you're going to switch. Everything else, you know, anything in between, like, you know, trading this area right here, or trading this area right here, you're just basically trading it as usual, and you basically, you know, defining the swing bias. So let's say swing bias here is going to the downside, so the majority of your trades are going to be to the downside. then you have the reversal, so the majority of your trades are going to be to the upside. And by the trades, I mean intraday trades. Then you wait for the reversal, and you do the same over and over and over until structurally it gives you a much better sense of leaving the trading range. And then from time to time, you're going to have something like this, where you intraday trade and you see a reversal within the trading range, and then you're just going to continue with that trade until you have some kind of change of character right there. And those trades are going to be small swing trades, like 2-3 days, and you are out, just because of the function of how trading range is bound by the resistance and the support. Yeah. Okay. Sounds good. Let's do our Q&A session, and let's see what kind of questions you guys are going to come up with. Okay, question number one. Can we look at how you would mark support resistance for Forex? Yes, of course. Now, Forex is going to be somewhat different, and I think I know what you want to look at. You want to look at that pre-market activity, right? So now with Forex, we are going to have a slightly different picture, and this is why we you know, it's going to be somewhat challenging, you know, talking about different markets. And I'm fortunate that, you know, I love trading, and I've traded a lot, and I've traded, you know, different markets. So therefore, I can go from instrument to instrument and discuss it like this. Okay, so I put here both the euro and the pound, but let's look at this question first. So let's maybe put like, what, 30 minutes. Okay. And right here, if you're going to use the same principle as to, you know, let's look at the pre-market activity. You will be thinking about pre-market activity relative to your market, right? So, for instance, if we are in the US, I would be thinking about like from 6 to about 1 o'clock. So here is this US session. But you could already see that the majority of the move happened during the London session right here. And Asian session here was actually inconsequential. Then here we have more to the upside in the US, less so in London. US, London, both sessions are really narrow. London, US. So our goal as day traders is, of course, to be in the moves like this. And this is news related, obviously, and news related to the US. You kind of expect the volatility in the US session to increase because of that news. But everything else is just going to be driven by the trends that have been established by big institutions. So in Forex, I actually did not find, I found that the majority of the moves that I was interested in actually happened during the London session. So that's why I was trading, you know, starting from like 10 p.m., 11 p.m., depending on, you know, the time of the year. And I was just, you know, trying to be there during this time. So you have to account for that, you know, and based on that, your support resistance boundaries are going to look different than in minis. I think that in minis pre-market boundaries work extremely well because it's a heavily oriented US market, rather than, Forex market where, London session is extremely crucial. This is where a lot of Forex exchange transactions are happening during that time. So I would not really put any boundaries, just based on the previous activity. So therefore, how do you deal with this whole thing? Can you still have some kind of boundaries? You can do the different session boundaries and you can experiment with that. I usually would have the daily boundaries and some slight interpretation on the session boundaries. So what do I mean by that? So I would just take one day, and this was an extreme day, so let's not use that. So let's say 311. So here's the boundary for this day right here. And then I would look into the boundaries for each session. So actually, let me just increase that. Okay, so here is the whole day, 311, 313. And then you would actually look, well, you want to look at the previous close. So you would look at, this is Asian session right here, and it goes up to here. So I still would use, especially with London session, a breakout out of the Asian session. So that signal is actually quite nice, and it could be quite consistent for the London session. And then when you go to the US session, you still want to understand what different sessions have done. So here we are at the open right here. And you're kind of like in the middle of the London session, so you had the reversal, probably a continuation to the first target, and then you have the second target right here. So you can see how I'm using this as a target potential of where the price can go. And you could see where the first hesitation occurred, and that occurred near the London session. So if somebody in London was selling at this point right here, they're going to still, have the same bias to the downside as the price comes in here. Or they can just start closing the position, and that would move the price up. So I would say that please experiment, use the same concepts, but experiment in terms of, for Forex is going to be a little bit more specific, to that market rather than like the E-minis. And for us, I hope that, that makes sense, and, I'm kind of answering the question that you had. All right, next question. Please explain the reversal bar entry a bit more. Okay, Ming, so we will be discussing this during April. So, I can go into that, but there are some details of that particular concept that we need to stop and just kind of like, go more through this because there are some combinations that you can have with some of the bars, and then I also go into the time and price stop loss and how we could use those two time stop losses. So it would require like a whole session to go through that. So why don't we just wait until April to do that? Is that okay with you? Okay, so while I'm answering, while I'm waiting for the answer from Ming, let's go to Karen. Okay, so could we have a quick look at the instrument selection for both Forex and indexes, please? Okay, yeah, so this is something that, we were intending to do. So for the Forex, you really have to think about correlations. There are websites that are giving you correlations for the past periods, like they would give you the correlation for the last week, last day, last month, and usually the highly correlated instruments like euro and pound against US dollar, and you see here how the moves are really correlated so much, right? Usually they are going to change that correlation from time to time, so you want to follow that up. Another way to follow this correlation is just look at the chart and visually, see whether there is a correlation here. So I see that there is a move to the downside here. I see that there is a move to the downside here in euro. So I see the correlation. So I'm going to be thinking about the comparative analysis and the strength and weakness before any type of entry points. So for instance, we are during this session in the US, and I'm seeing a structure here, and I'm seeing a sloping down structure. So this looks weaker. So therefore, my inclination would be to, if everything is based on the upward movement, and we have the daily swing to the upside, and we have the intraday structural bias also to the upside based on phase C here, then we could open the position in the instrument that is stronger than the correlated instrument. So euro is behaving much stronger intraday and on a daily basis lately. So therefore, my preference would be to come in and to open a position in euro. And I think that, comparatively, we see that it's a much better move. So first move to the upside is much stronger. Then the next bar is stronger as well. We have, a close below the previous day's close. The bar close. Then the next two bars is to the upside, and they are making actually a new high, so also stronger. Here, this movement is already somewhat limited. And then after that, we are seeing still some strength here, but this move is actually, no, it's actually good. Look at this move right here relative to this high, which is here. Where? Right here. And look at this move. We are definitely comparatively traveling much more on this move to the upside. Again here, okay, so here is the low, here's the reactional low, and here is a move to the upside. Okay, so this corresponds to this. So, and then after that, something changes, right? So, and this is a very frequent occurrence of this. We're still looking at highly correlated instruments, but, within the intraday structure, the strength and weakness can change so quickly. And this is very specific to Forex. I don't have the explanation of why this happens. There might be some importers, exporters that coming in during this period right here, and they're like, I need to buy pounds and I have US dollars. So they're gonna just start buying without even thinking or the structure or anything like this. They just need to buy a pound. So therefore, they can push the price like that. Or another situation, in a highly correlated currencies, big institutions are going to see undervalue by one currency, and they might start pushing it up, to have the parity with another one. But the key for us technical traders is just to identify that change. So this is a different behavior than this. So therefore, we would be thinking about first exiting here Secondly, this is a continuation trade right here after the reaction, so we might establish a position right here. So then this is how we would be constantly looking at both of the currencies, and we would be comparing, all of the swings to the upside, downside, and we would be basing our selection based on how this strength and weakness changes. Very similar to stocks. I mean, we looked through that screen where I had the cues and 3 stocks, and we would be looking at how that strength and weakness interact, on the price basis, and we would pick a specific stock because it was either outperforming or underperforming. Here, the same idea, and we're just trying to get into the stock on the long side that is stronger, and then once it changes, we want to buy another stock that, or another stock currency that is at that moment a stronger currency. Okay, so the same for indices, right? So we're gonna have, let me do this. So we're going to have Qs, we're going to have Russell, we're going to have, actually don't look at, okay, let's look at diamonds, and let's look at, okay, Qs, diamonds, spiders. Okay. And now I'm going to change it to, let's say, 5 minutes. So even in today's action, I think maybe like yesterday was better. No, doesn't matter. So the bias is all to the upside. And I'm just using here the ETFs, but basically you can go to the futures and have the same thing. And that's my preference, just to look at the futures. I just convert that to the stock screen. So you're basically doing the same thing as we did with stocks. You want to see what kind of opening you're going to have, what is stronger, what is weaker at this opening. So we see that NASDAQ 100 is opening to the downside, whereas Russell is actually having a much better opening. Dow Industrial is having a better opening than Qs, and then Spiders is having, the worst opening. So this is the strongest at the opening, so you might as well establish the position just depending on, on the structure. So you would have to go back, and here you see that there is a continuation of the trend, so you might as well just open on the continuation, or you might wait for the first 30 minutes and then just to see what the price is doing. And this move to the upside, again, on the comparative basis, is much better than, let's say, this move right here, where we're going to 9 o'clock, okay, or this one, or this one. So there is more room for us to operate here as day traders. And then during the session, you might as well, just think in terms of the price reversals, and then comparing to the indexes that are maybe exhibiting some weakness or more weakness. So for instance, if I'm looking at the spiders and I'm looking for some reversals, so for instance, reversal right here to the downside, so that happens on at 8:25. So where are we at 8:25 on everything else? I see that with Russell, we're still relatively strong. We are above our opening, so I don't want to short this, and that was a good decision, because what am I doing if I'm going to short here? If I'm identifying this as a potential reversal, yes, there is something for me to go down, but because it's so strong, it's being supported, I'm not going to have a big movement. Now, another 825, so we are somewhere here, and we are here. We're seeing that the Dow is also stronger than the spiders, so there is no reason yet, at least, to short. And the Qs also came up to the opening right here, actually kind of like the same area. Okay, let me see. Okay, hold on a second. Okay, so this is where we are actually getting the signal for the spiders, like right here in this area. So we might consider opening a short position here after the failure. So again, at this point, you would be looking at what is strong, what is weak. And actually, spiders is weaker than anything that we see on this chart. So we're going to open up a position in spiders and just, close it somewhere here on the reversal. Even though it seems like Qs were a much better trade to the downside here, but, structurally and comparatively, spiders still had a higher probability that is going to outperform to the downside. So it's the same type of analysis that you're going to do on the intraday basis with stocks, currencies, and with indices, index futures. Okay, so I'm glad that we've covered that. So let's go to the next question. What about choosing what to trade when considering non-correlated instruments? Are we just basing it on daily structure and bias and 4 hours, 30 minutes structure and the bias? Yes. So we basically, let's say, give me some kind of currency, Karen, maybe for us to consider that is not going to be, highly correlated to anything else. So we're looking at the New Zealand dollar, and we would be doing our analysis as we do it usually. So we would look at the long-term structure. This reminds me of euro, right here. This TP formation, only there is more upthrust action. First move, second move, we are in some kind of consolidation. So for us, the long-term structural bias is just sideways. We would look into the structure and create the bias based on that structure. So we would go into the daily, stop in action, and we probably, yeah, by the way, did we have a change of character on the long term? Yeah, this rally right here looks like a change of character, so we might be here for some time, or we might attempt actually to go up at this point. We have broken the trend here in this area, so we might have some kind of up bias at this point. And I'm looking at this as a climactic action, swing up, swing up, swing up. So you could put either phase A like this or like this. So depending on how you do this, now I do it like that probably. Okay, yeah, first phase A here, maybe B, either B or C. So the bias is to the upside. On the weekly, we're probably really clean in this swing, and we're close to the resistance. So we only would be looking at this smaller trading range as a potential way of continuing to the upside, but there might be some kind of reversal right here. So structural bias could be defined here a little bit later on, just depending on what happens. And then we would go to the intraday. Again, define the bias, swing bias. So for instance, we are done with this swing. So on the hourly, we are in the downswing. So that's going to be the primary bias for us on the intraday. And we would be looking contextually into this as well. So probably an upthrust. So we actually, the next high probability move is to the downside. So on the intraday, so on the daily, this could be different, and that's how we would look at that. Yeah. So structure, daily swings, intraday structure, intraday swings, and then just going into the smaller time frame for the point of entry. So it would be good to have a hierarchy based on structures on different time frames of higher probability moves. Yeah, definitely. I mean, I'm kind of like going from one time frame to another, and it's just like so natural already at this point. I mean, yeah, I can remember, very easily the structure. But if you guys feel like putting it on paper is better, I always would suggest that. I actually for like years and years was keeping a trading journal for each day. So I would do like a post analysis there. I would do my analysis, and what that does is just helps to keep your mind always on cue as to where we are structurally, because sometimes our minds is distracted. And same for indices and metals versus oils, etc. Yeah, for sure. I mean, with metals, I've never traded metals except for the gold and silver ETFs, but I've never traded futures on gold or silver. So this is probably one of those areas that I've missed as instrument. But there are silver and gold is going to be highly correlated, so you want to always have that correlation going and look at what's better. And reversing so nicely. Okay, and then what am I thinking? Silver. Yeah, so I'm putting ETFs again here because I'm just more familiar with metal ETFs like that. But you could see on the daily basis, you could see this on the intraday basis that comparative strength is important. I mean, look into this area right here in gold. We're already going up. What is happening with silver? We are going up, but not so quick. We're already here at the 1/2 of the move that we've had prior. We are definitely weaker in silver here than in gold. So therefore, I want to establish a position and have a swing position in gold rather than in silver, and look comparatively how much nicer this move is. We are overcoming this resistance, and in silver we are just failing. And then of course on the intraday basis you're going to do the same type of analysis. So anything slightly correlated like this, you're always going to have this type of analysis. Even for those of you who heard about pair trading or spread trading, that's basically the same concept. You take two stocks or more, the stocks that belong to the same industry group, that are somewhat correlated, and you create you buy one and you're short another one, so you effectively create a spread. And when that spread becomes positive and it's at the maximum, you just sell that spread, and then you establish the spread again. Okay, what else? There were some questions. Okay, so selection of the right instrument, comparative, VPA intraday. Why don't we leave this question, Kiran, why don't we leave this question for the market outlook session? Yeah. What I would like to do is I would like to put the true VPA by HDSI on the intraday, and then just let's look at that. Because I know that it's still gonna find a lot of, and I'll try to find both examples when, you know, it's gonna produce a really good result and then where it's just not gonna make sense. You know, in some instances, that's how it's gonna be, you know, because in some instances, there's gonna be a lot of volatility just based on nothing, not necessarily on accumulation or distribution. There's going to be a lot of volatility of somebody just needs to get rid of the position, and even though it's an accumulative pattern, they're going to produce some kind of, you know, shakeout action even within, let's say, phase D, and it wouldn't make a lot of sense as to how to read that. But let's have a look. Let's play with that. And maybe not this Wednesday, but we'll see, you know, because I want to open up next Wednesday to everyone. But we'll definitely look at that. And thank you for a great question. All right, anything else? Any other questions? Any other comments, guys? I'm surprised how quickly this whole day went. I hope that you guys enjoyed the whole workshop. This is the first time when we conduct the intraday workshop, so I've been preparing a lot of content going through some of the concepts that I'm not necessarily using anymore, but you know, some of them I'm actively using, and you saw, like with Eminius, you know, this is where I probably have you know, a very good you know, advantage there. So I think that by the time we're going to have the next intraday workshop next year, you know, I'm probably going to add some of those ideas. I'll let you know if I do. But overall, I think it was a good first try, a good first intraday workshop. I'm going to send evaluation forms to you either tomorrow or Monday, probably Monday. So please make sure that, you know, you give me some kind of feedback because it's crucial for me to understand, you know, how relevant the information that I'm bringing to the table to you. I mean, obviously, I've developed already, you know, my style, but it could be a different style from what you do, or you might say that, you know, or this is, you know, a little bit too complicated or a little bit too simple, and so on and so forth. So I want to hear that type of feedback and want to see what you guys are thinking, you know, as to the value of this product. I really appreciate all of you spending the whole day with me. I mean, it went so fast, at least for me. It just feels like I just sat down in front of the computer. And I just hope that you got a lot of insights, a lot of new ideas on how you could day trade, how you could combine your day trading and swing trading. So we're not actually, we're talking just, you know, day trading. We definitely, you know, we're talking about the effectiveness of day trading, and then how that relates to the effectiveness of the swing trading, and, you know, how can we combine both ideas. And I think that if you could take that idea of the switch was probably one of the important ideas, you know, that I've shown. But there are also a lot of small ideas that are related to the specific markets, like we've discussed currencies, we've discussed Eminius, stocks, and I think, you know, those specific market specificity is very important during the intraday. Another idea that we've discussed that is extremely important is how do we select a specific instrument, or let's say a stock out of many stocks, an index out of many indices, a currency out of other currency pairs. That selection mechanism based on the comparative analysis is extremely important as well. Also, I hope that you might adapt some of the general guidelines and rules that I have for different markets for the day trading, and those are based on my observations of the day trading that I've done before. The concept of the swing reversal is extremely important. The concept of this understanding the structure is extremely important, the context of the structure, and therefore creation of the bias based on the structure. And when you combine these two biases, the structural bias and the swing bias, this is where you're going to get the best result. So you always want to go with the trend or with the bias. And, if you do this consistently, as your homework before the session starts, then everything is easy. You're just looking for the reversals in the direction of that bias, near the supports or resistance, and off you go. All right, guys. I think that's it. Again, thank you so much. The videos will be posted next week. I'll let you know, and I'll give you the access to all of you. You already have the slides. Evaluation forms will be emailed probably on Monday. It was my pleasure to spend all this time with you. Thank you a lot, and let me know what you thought of the workshop. I really appreciate the feedback. All right, thank you guys. Have a wonderful Sunday, and I'll see you either at the Market Outlook on Wednesday, or I'll see you in the classes. So just shoot me an email, and we can address any questions or comments that you might have. Thank you, guys. It's been my pleasure. Bye-bye.